the Fed is going to follow through. And there are two indications, I think, that it will. One is they've said that they're going to raise rates 50 basis points more. Lisa's already highlighted that the inflation, a lot of inflationary signals, especially, those leading indicators are already falling. The Fed is focused on the lagging indicators, housing, right? And they're looking at that data, even though we know we're going to have a reduction in construction employment and such. And they're looking backwards, right, in terms of their inflationary expectations. So what does that mean? I'll just give you one example. Why will there be less employment in the United States? All of the houses that were started a year ago are ultimately going to be built, and there isn't going to be demand for new ones. That's going to take out 400,000 of 900,000 residential construction jobs. We could lose 2 million jobs next year. So what I'm looking at is a situation where only when the Fed actually sees unemployment will they begin to pivot and reduce rates. By that time, it will be too late to actually sort of say we're going to have some type of soft landing. We'll already be in a declining, employment situation for potentially the next 6 to 12 months. And so to your point, if that is exactly what happens, right, investors have to be defensively positioned now and in equities, and then become offensively positioned in more aggressive things next year. And they should be, having a fully invested portfolio, and it's clear to us that they do not.
So, David, and this is frustrating for a lot of people, if everyone's forecasting the same thing, so we're all waiting for this recession to hit, for equities to roll over, then we're all going to buy because there's going to be this great recovery in the second half. Why don't I just buy now?
Jonathan, if people actually bought now, that would be fine. I would actually much prefer people to have a fully invested portfolio of stocks and bonds today than to actually have 20% of their money in cash, because there's no way that they're going to be able to do the right market timing. The critical point, though, and where there is not consensus, is on what you want to be owning on the other side. And there's a lot of areas of beaten down, whether it's non-U.S. equities, whether it's small caps, whether it's technology, high-quality technology shares, lots of place in the market. I'll tell you one area of the market that I think investors are also overlooking, which is, what if we don't have a terrible credit cycle, actual defaults and things, but we have what Lisa talked about, which is a lot of illiquidity. There are lots of bonds right on the periphery that are trading now with 15% handles just because of the illiquidity, but not because of credit risk. So, as I said, I think that the Fed is going to cause an unusual circumstance. And I think that people have to really respect the market. They have to see what's going to happen before they then, rotate from one type of equity investment to another.
John was speaking with Savita Subramanian of Bank of America yesterday, and she does not think tech is going to remain a leader in the upcoming cycle, that people are perhaps conditioned by past performance. Do you disagree, and why? Why is that still an area that you should own?
I could not disagree more than with that, but let's just take cybersecurity as an example, right? And let's just take a look at big banks who have spent, 300% more on cybersecurity over the course of the last 5 years. It's an unstoppable trend, right? Healthcare, an unstoppable trend. Take a look at biotechnology, drug development, same thing. Take a look at energy technology. Right now, Europeans, if they just bought heat pumps, could literally take your dependence on gas down by 35%. So tech is going to provide us with, I think, an enormous amount of growth going forward, but it is, at the end of the day, a replacement for capital spending. That's what it is. Instead of buying new equipment, we're buying new software, right? Instead of going out and building new factories, which we are in the United States, we're going to automate them with robots. And so that, to me, is unstoppable. And what we want to do is get our clients invested in that, right, at much lower prices, which we can now, by identifying which companies are well-positioned and also which have the managements that have now just been through one of the most difficult periods in history economically in terms of all of these vicissitudes, and now they're going to go out and demonstrate that leadership. So to me, we're going to have a tech is back moment in the spring.
Is that meta, David?
I don't think, no, I'm not talking just about the leadership of 4 companies anymore. That is just, the largest companies, every 10 years, we know that there's a rotation of leadership, right? What I'm talking about is the group of leaders behind them that are working, on cloud-related activity. We just simply have seen so many opportunities for truly transformational tech gains, and those companies are readily apparent to us.
David Bailyn, wonderful to catch up with you, sir, as always, of Citi Global Wealth. I think that's the real distinction between Savita and what David's talking about. I mean, I don't think they would disagree that much. I think Savita's talking about the major weightings of the S&P 500, and it's why she doesn't like the index at all. She was talking yesterday about outdexing, just taking these out. She still wants to own cyclicality. I keep going back to this. What Savita said going into 23 about under-owning equities being the risk and still wanting to own things like energy, wanting to hold on to it into 23 when everyone's going around saying recession is just around the corner.
You are asking what happens if it doesn't come as quickly as people think.
Sure.
That is potentially the scenario that she's saying is the biggest risk there.
It's got to be a key question we ask anyway. Ellen Wald's coming up. I'm looking forward to this. She joins us from the Atlantic Council. She's the author of Saudi Inc., which I think is a good time to talk about she and Riyadh. Up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Union has announced a 9th set of sanctions against Russia. It includes restrictions on drones, chemicals, and technologies used for military purposes. The measures were made public hours after Russia's President Vladimir Putin warned that the threat of nuclear war is rising. Bloomberg's learned that the Netherlands is planning new controls on exports of chip-making equipment to China that could align with Dutch trade rules with U.S. efforts to restrict Beijing's access to high-end technology. Washington has been pushing its allies to join efforts to cut off China. The Biden administration taking sides against Google in what is seen as a consequential case involving social media. In a Supreme Court filing, the Justice Department argued that social media websites should be held liable for promoting harmful speech in some cases. The case involves a family wanting to sue Google over a terrorist attack. In Peru, the country's 6th president in 4 years begins her first day in office trying to build a cabinet and restore confidence in the economy. Dina Boluarte took over Wednesday after President Pedro Castillo tried to suspend Congress and call for a new constitution. Castillo's moves were described as an attempted coup. Congress voted to impeach him, and he's now being detained. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Saudi Arabia understands that it can't put its chips on one side or the other. And I think although they may meet with Xi, the reality is that Saudi Arabia depends a great deal on weapon systems, on support from the United States. That's not going away.
Fascinating how this meeting's come together this week. That was Leon Panetta there, the former US Defense Secretary, live from New York. Here's a snapshot, a sneak peek of some of the price action for you this Thursday morning, going into jobless claims in about an hour and 44 minutes. Equity futures are positive by 0.2% on the S&P. 5-day losing streak, trying to avoid making it 6. Yields right now up by a couple of basis points on a 10-year, 344.20 in the FX market. Euro giving me nothing. Euro dollar 105 next week. Not just the Fed, the ECB decides the day after. So the Federal Reserve leads are on the 14th. The ECB is on the 15th of December.
The yield that I'm watching is the 30-year, which has been down and steadily down and is at the lowest going back to September. The longer-term bet that we are going to face real disinflation, to me, I find interesting amid a sea of muck that we see in the rest
Just
of
to
the
be clear here, you're jumping on the disinflation bandwagon going into 23 in a much more aggressive way.
I'm not jumping on it yet, but I'm kind of becoming more...
You're having a look at it, thinking about a ticket?
I'm thinking about buying a ticket. Yes, that's exactly it. It's just that if you start digging underneath and looking at some of the forward indicators, whether it's even rents and how quickly they're softening, whether it's housing, even some of the labor market data that shows a bit of softening around the edges, I kind of understand where people are coming from. Maybe not as quickly as people think, but I'm kind of understanding it more.
Do you expect to hear that from Chairman Powell next week in the news conference?
I would hope not, because I hope that he doesn't know nuance, because this market doesn't read nuance, and then we have to discuss nuance.
Really doesn't. I think we saw that after Brookings.
I mean, and then it's going to be like, how do we explain this? We don't. People are just, it's algos.
And there's no space for on the one hand this, on the other hand this. This is blunt. Look at this for a lead paragraph in our story on Xi. 2 months after snubbing US President Joe Biden's pleas for oil, Saudi Arabia is rolling out the red carpet for its Chinese counterpart, Xi Jinping. Alan Wald joins us now, senior fellow at the Atlantic Council and author of Saudi Inc. Alan, how significant are these meetings this week?
I think they're pretty significant, especially from an oil perspective. And I think they're much more significant for Saudi Arabia than they are perhaps for China, because the Saudis have long had very strong oil ties with China. I think a lot of people don't realize that these go back all the way, in fact, to 1989, when Ali Naimi, who was then the CEO of Aramco, went to China to try to see, what kind of interest there might be for Saudi oil there. And he didn't really see all that much, but he's had his eye on China for years. And as soon as he saw economic development there, basically kind of pounced and was able to get some really good long-term deals for Saudi crude oil there. So I think this is partially a way of reminding China, hey, we're your really good, stable crude suppliers. We've got a lot of joint ventures and petrochemicals in China. And yeah, there's a lot of cheap Russian oil in the market, but don't forget about us. And then at the same time, Saudi Arabia is definitely trying to see if it can capitalize on this relationship with China and build even more economic ties, more business ties that go beyond oil, which is something Saudi Arabia really wants to do. Whether or not this can extend into the political and the diplomatic sphere is really, I think, the big question for these meetings.
What do you think the message for America is?
I think the message for America is that China is also looking to put itself as a player, a really big, important player out there in the political and diplomatic arena, and that the United States is no longer the biggest or the only force in the Middle East. I think militarily, China is not looking to supplant the U.S. in any way in the Middle East. China doesn't really have any interest in kind of defending the Middle East as the U.S. has put itself out there for. So I don't think that there's really a concern when it comes to that, but there's definitely awareness that the United States is no longer Saudi Arabia's most important economic relationship. Now they've got a really important economic relationship with China, and that's the message here.
Is there also a message about China reopening and trying to secure enough crude, enough of the fossil fuels that it needs to support its economy?
Yeah, that's a really important point. And I think that the fact that this meeting was planned before China had decided to relax its zero COVID restrictions kind of gives you a sense that perhaps they knew that this was coming, or perhaps even the Saudis knew that this was coming. The fact that OPEC hasn't made any major moves says that they definitely see that even with China reopening, the market, for oil is definitely potentially still soft. But I do see this as kind of heralding that movement.
I want to pick up on that, Ellen, that even with China reopening, the market, the demand side of the equation is still softening for crude. Can you explain how the current market pricing of oil makes sense to you, given that we are seeing a potential opening up in China that, as one of our recent guests said, is much faster than he expected?
Yeah, I do think that what a lot of people are looking at now is very much the financial market, is how much crude is out there. There's still oil being released, I think, from the SPR. I think as that winds down, if it does indeed wind down, we will see oil prices pick up a bit. But also, this time of year is not usually a big time for oil demand. So there's also that to take into account. There's the economic issues in Europe, and we just see in general, things are not looking all that strong right now. But I do think that going out, farther out, we will probably see a pickup in demand. Maybe not, as your previous guest said, until, if we're going to be in a recession for the first half of 2023, we may not see it until after that. But I think that OPEC is kind of playing it safe here. They made no changes. They're waiting to see what happens in the market. I think their decision to cut earlier in this year was probably the right one economically and financially, even though the United States was very much displeased.
The right decision, Ramo, from OPEC Plus. After all the pushback we heard from a couple of months ago, was it the right decision?
Now let's see what happens.
Low 70s kind of say maybe it was.
Yes. Now let's see on the flip side, do they start refilling the SPR? And
well, that's the question.
This, right, because are they going to go in the opposite direction? And then do people start screaming, you guys are artificially increasing prices? I mean, honestly, because at what point does the U.S. become the marginal swing producer or the swing demand provider here?
Ellen, let's squeeze that in. The SPR, what's your understanding of when the U.S. administration comes back in and starts buying again?
Yeah, exactly. I mean, how soon can they start buying? Can you legitimately start refilling the SPR while you're still draining it? That's a really good question, because I don't think the last release is happening. I think it's happening right now. So I do think they're going to wait at least until we hit the $70 mark in WTI. But then there's also got to be oil for them to buy. And, is there U.S. oil that's being produced that's available for them to buy? And that's a good question. And is our companies going to want to sell to refill the SPR when they could be selling potentially for a little bit more overseas or whatnot? I think that's the question. And we could potentially even see U.S. buying maybe some foreign oil for the SPR. And remember, they need to buy heavy oil. They can't just refill it with light oil from, the Permian.
Ellen, can you just talk to me quickly about the politics of buying foreign crude to fill up the SPR? How do you think that's going to play out?
It's not going to look good. The truth is, it has to happen, because you can't just have an SPR full of very light crude oil. It's not going to work, particularly for American refineries. If they have to use it for some kind of, national emergency, or say there's a hurricane, you're going to need various different types of crude, but it's not going to look good.
Ellen Wald, thank you, of the Atlantic Council and author of Saudi Inc. Fantastic conversation. Lisa, this is the problem. Whenever you talk about crude, the political conversation is not too far away.
The political conversation is complicated because it affects what everybody can spend and their spending power on one hand. So that's the sort of populist feel. And it also affects industry, right? Especially for an oil producing nation like the United States, which you have some people saying, well, you want to support U.S. businesses. And then there's also the question of how do you reduce fossil fuels? Where is that? Did you see State Street moved away from certain ESG types of filters? Basically, or the sort of
they're under some pressure. Let's be clear about that.
They are under some pressure. And the fact that they're getting some big pushback, particularly in states that think of this as a political endeavor and are penalizing certain funds for this type of behavior. Then you have others like the Norwegian Sovereign Wealth Fund that actually came out and doubled down and actually cut ties with certain companies for not being truly zero emissions enough. Highly politicized.
Did you see the latest in the UK? They approved the opening of its first deep coal mine in more than 30 years. Coal.
Yeah, not exactly saving the world.
That's an about turn, isn't it?
This is about survival in a winter that hasn't been cold yet. But did you see Javier Blas's column?
You say yeah. I tell you what, my family, the messages ping, ping, ping every single morning. It's freezing in the UK at the moment. Freezing.
Can you fork over a little bit more for the heating bill? Come on, son.
Hey, my mum hasn't asked that question.
No, but she'll do it anyway. I know you.
Maybe around Christmas. I don't know.
Here,
We'll see.
Pete for you.
Anastasia Amoroso.
Under
You
the
think that's
tree.
what I'm like with my family? Give me a break.
I know that you spoil them.
They don't even have to ask. From my capital, up next.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Gen Z can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro miniskirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
We're switching from right now inflation fears to recession fears.
We're in a good spot right now, but I think more deceleration is to come next year, unfortunately.
You are going to look at a fairly substantial amount of downgrades.
Look, a recession is not a question of if, it's a question of when.
At the moment, we have OECD economies essentially growing zero next year. But of course, if the US Fed fund rates go to 6%, 7%, that could become negative pretty quickly here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK is going to come back in a couple of days. Equity futures not doing much this morning. Slightly positive through much of this morning, up 0.2%. 5-day losing streak. Trying to stop it becoming 6. Looking ahead to CPI next week and a Federal Reserve decision.
But this losing streak didn't feel dramatic or scary. It wasn't something that's sort of a reset in terms of what people are expecting or some kind of dramatic catalyst. It's sort of a settling into the theory that we're hearing from everyone. Bad first half, good second half, done.
Is that too cute or what? Down in the first half, up in the second half. It gets bad in the first half. The Fed has to back away. Then they cut. Then there's this massive recovery trade you don't want to miss. Just don't go too early. Wait for it.
We've asked people, is this too cute? And they say, well, there's a lot of variances underneath that, right? Like there's a lot of bumps, and getting the bumps right are really important. And actually what David Bellion was saying, it really stuck out to me, and not to sort of, mock the thesis, because it makes sense, and saying it's not about what's going to happen, it's what do you want to own on the other side, to sort of pick up now versus waiting for that perfect moment where you can understand, okay, we're heading into the
I'm not mocking the thesis. I think it makes sense, and that's why everyone came up with it.
Yeah.
And because everyone's come up with the same thing, I'm wondering how we trade it.
And
that's ultimately my question going into 2023.
Which is the reason why you asked, and we've been asking, why not just buy equities now? And really the question lies with what will be the leadership, and that's the reason why your conversation with Savita Subramanian of Bank of America was really interesting, because if it's not going to come from the big tech names, then perhaps the index level won't necessarily drive the same kind of shifts and gains that you see under the hood.
I think she called it outdexing. You'll hear more of that. You'll hear more of this too. Bonds are back.
I had a dog named outdexing. Anyway.
You sound like Tom.
I sit in this chair. I'm going to have to raise it up.
That's what you have to start renaming dogs and pets. Weird stuff. Equity futures on the S&P.
It's like I'm just moving. I can't.
Is that what that chair does to people?
People start naming their dogs weird things.
Futures up 0.2% on the S&P. Yields up by 3 basis points, 344.75, and euro dollar going absolutely nowhere, 105.07. We'll keep coming back to this on crude. Just the idea we might finish lower on the year is just remarkable. Crude right now, Lisa, $73.26.
Can we sit on what Ellen Wald said? That perhaps OPEC Plus was right not to increase production, to cut production, and that the U.S., if they have to refill their SPR, might have to buy foreign
Well, you know
oil.
what the White House would say? Steady on. If we didn't drain the SPR, where would crude be? That's what they'd say back to that.
Well,
but I think OPEC Plus are bound to say, yes, we were right. Look at where prices are.
And she pointed out, though, that they're still doing a release of the Strategic Petroleum Reserve right now.
At the same time, we're talking about refilling it.
Again, try to make sense of this market. It is very unclear, and it is a very difficult time to understand, especially if you do expect a pretty bad first half, even though you do expect a good second half. 7 a.m., this is what I'm watching. ECB President Christine Lagarde is giving a welcoming address at a European Systemic Risk 6th Annual Conference. Does she talk about the prospect of over-tightening? Does she push back against some of the recent easing in financial conditions? Does she really reiterate what we heard from Chair Jay Powell, or will she press on and continue with saying recession isn't going to necessarily bring inflation down to where we need it to be? 8:30 a.m. initial jobless claims. Again, another indicator of whether we're seeing a little bit more of a softening in an otherwise pretty tight labor market and aftermarket. Lululemon and Costco earnings. I do want to just point out a correction. Lululemon does actually sell suit jackets for men. And I saw them, and I do think, you were asking about where you can find suits, and I would like to point that out. But anyway, Costco is also reporting earnings after the bell, down about 15% year to date. Just a sense of the consumer. Do we see a downshifting in terms of upper and middle class consumers going to lower cost companies, lower cost grocery stores, lower cost goods as they face inflationary headwinds?
No comment. I've had a lot of comments from other people.
Really? What'd they say?
Ridiculous.
Like what?
No chance. Blasphemy. Sinful stuff. Lululemon suits.
Yeah.
Absolutely not. Anastasia's coming to talk to us. We're going to keep talking about this. Anastasia Amoroso of iCapital. Anastasia, great to catch up with you here in the studio. Blackstone and this real estate fund. Can we start there? This in the FT. The Blackstone chief, Steve Schwarzman, dismissing concerns over this $69 billion real estate fund. And here's the quote from Mr. Schwarzman. The idea that there is something going wrong with this product because people are redeeming is conflating completely incorrect assumptions. This was not meant to be a mutual fund with daily liquidity. These are pieces of real estate. Can you give me your view on what's been going on here?
Yeah, so this is an industry trend, and there's two stories to this. There's the redemption story, why redemption's rising, and then there's the limit on redemption story. And what I would say about redemptions, it should not really be a surprise to anybody that investors want to redeem. Because if you look at commercial real estate and the performance of it in the first half of the year has been rock solid. It's up 9%, while the 60-40 portfolio is down 16%. So if that happens, it means your commercial real estate exposure might actually be a little bit out of balance. And over and above the allocation limit. So investors move to right-size their allocations because of how well commercial real estate has performed. But there's the other side of this, which is we know the environment is likely to weaken for commercial real estate in the next couple of quarters. So I think some investors move to lock in gains because they expect the depreciation. So that's the redemption story. So it's expected, and I don't think there's really anything earth-shattering about that. The second part of this is limits on redemptions. And I truly believe it is in the investor's best interest because, John, you pointed this out. These are semi-liquid, non-traded REIT products that the underlying is illiquid commercial real estate. Imagine if there are no limits on redemptions and if everybody could redeem, what are the fund managers to do? They would have to sell all those underlying commercial real estate properties, and that would cause more of a negative feedback loop. So the fact that there are limits on redemptions, I would say, is actually a very good thing and kind of breaks this negative feedback loop cycle, and it protects the investors that are staying in the fund. And by the way, none of these products right now are struggling with performance per se, and none of them are not paying distributions. They're paying income out to their investors. So I think, a lot of kind of the negative sentiment about the limits and redemptions is overdone, and this is in the best interest of investors.
Do you think we can ultimately avoid fire sales? Is this sufficient?
I think some assets will have to be sold. I don't think there's avoiding that, but I do think that if you look at the space of non-traded REITs in general, a lot of the products there, rightfully so, have put limits in place in case they do see redemption. So that in of itself should prevent us from having mass fire sales of commercial real estate property. But having said that, I think there's some challenges for commercial real estate in the next couple of quarters. We've seen the reset in rates, but we've not seen a reset in cap rates, for example. And if you look at the cap rate on multifamily, for example, it's 4.5%, and it's rock bottom levels. I don't think it's going to incentivize investors to step into the sector until those cap rates move higher. And I think that happens at some point. The other thing that's likely to happen for commercial real estate is the NOI growth, the net operating income growth, is likely to slow down, from 7 or 8% to probably 4% next year, assuming there's no recession. I think we should assume there is a recession, so it's likely going to be slower. So I think we're going to have a correction in real estate prices in the coming quarters, but here lies an opportunity for investors. I think the right move is you stick with some of the exposure, you get the income, because a big theme for us has been get paid while you wait out this volatility in the equity markets, and then when we've seen the reset in property prices, you step back in and add more to those real estate portfolios.
There's a larger issue here, though, which is, are we understanding the vulnerabilities of a private market that includes a whole host of real estate assets that isn't trading, that hasn't repriced, that you haven't seen massively go through some of the turmoil that you're seeing in public markets and is becoming subject to more withdrawals? Do you foresee some sort of upcoming turmoil as a result of that, especially as some funds try to transfer more into public debt into other public assets that now are offering real yield?
Yeah, there's definitely going to be a further reset. And I think anybody who knows anything about private markets knows that it's going to happen with a lag, but it is going to happen. It might not happen to the same degree that, for example, the real estate reset is happening in public markets, but it will happen. So to your point, Lisa, REITs have already corrected. They're down 30% or so. And so I suspect some of that weakness is going to show up in private market valuations. But it's not something investors don't know. Whether you're in private credit, whether you're in private equity, whether you're in private real estate, you should expect lower marks in the coming quarters. And again, for investors who are invested in some of the funds, that's just the expectation, but you're still getting the income on something like private credit. For investors who are looking for opportunities, and I think 2023 is going to be the year of opportunities. John, Lisa, to your point, the second half, the first half is your, reset in risky assets, and you start to get back in. So what do you get back into? You buy private equity, you buy commercial real estate, you buy private credit once you've seen that reset in the next couple of quarters.
What do you make of that being the consensus? Does that make you slightly uncomfortable going into 23 that everyone's saying the same thing?
I'm consensus, and nobody likes to be consensus, but at the same time, we sort of know what the rules of the road are, and we know what the Fed is trying to solve for. We know they're trying to accomplish below, potential growth, and they're trying to bring down inflation, and they have to get rates to 5%. So, everybody sort of knows the formula, and I think given the variables, that's what we're solving for. And, if you look at the first and second quarter of this coming year, consensus is minus 0.1% GDP growth. So that's the print already. And if the rate goes to 5%, that can't be a good recipe for risky assets.
Can I ask you about the balance of risks? That's the base case for you, I understand that. Do you think there's more chance that recession gets delayed or more chance that recession gets brought forward? And once you've given me the answer to that, can you tell me how you would trade that if it developed the other way?
I think there is a greater chance that the recession is brought forward. I've seen estimates out there saying that maybe this is not until a 2024 event. But, John, for that to happen, you have to have normal Fed hiking conditions, which is the Fed is hiking when the economy is still strong. But the Fed has been hiking while this economy has been weakening for the last 6 months. So, the typical relationship where the yield curve inverts and you have 15 months until a recession onset, I don't think that holds this time around. So I think chances are that Q1, Q2 of next year is when this slowdown, possibly a recession, occurs. And I think that's what people are starting to pre-trade now, to your point, is, we kind of thought that December is still going to be a positive month for equities, but now the consensus is the first half is going to be weak. Well, guess what everybody's doing?
Right.
They're pre-trading this, so I think we're pulling some of this forward.
Anastasia, awesome, as always. Anastasia Amoroso there of iCapital. Thank you. Be interested to see how we respond to that CPI print next week. We get a downside surprise there, whether this whole story changes going into 23.
Yeah, it's a very complicated issue. If it's a downside surprise, then people believe that the market is slowing more. I'm struggling with these nuances, like oil prices coming down, gasoline, that then gives people more money to spend. And all of a sudden, discretionary spending goes up. And then you get into this weird, bumpy cycle where it's like, are we accelerating, are we not? How are people feeling better or worse?
It used to be easy, didn't it? Just buy stocks.
Yeah, it was just easy money.
I hate that phrase, easy money.
I'm going to just use it throughout the morning.
Did it ever feel easy for anyone?
No.
It never felt easy
for
anybody.
No.
In the next hour, Jim Paulson and Luth Hold. Looking forward to that conversation. Futures positive 0.2%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is warning of prolonged power shutdowns due to Russian attacks. In his nightly address, Zelensky said capacity was constantly being expanded, but it won't be possible in the short term to return the power grid to its pre-war state. Hong Kong is taking another cautious step toward a full reopening. The city has shortened the isolation period for people who test positive for COVID and their close contacts. Plus, inbound travelers will be required to take 2 fewer rapid tests. Hong Kong has been slowly rolling back the COVID rules that have kept it isolated from the world throughout the pandemic. President Biden will announce a $36 billion bailout for struggling Teamsters Union pension fund today. It will help shore up one of the nation's largest multi-employer plans. And it will deliver help to the president's union allies after he angered many in organized labor by signing legislation imposing a contract on railroad workers. Elon Musk bankers are considering providing the billionaire with new margin loans backed by Tesla stock. Sources tell Bloomberg the move is one of several options the Morgan Stanley Group may take to soften the blow of the $13 billion of debt Musk took on to buy Twitter. The company could face about $1.2 billion in annual interest costs under the current debt structure. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want
want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We're switching from right now inflation fears to recession fears. The bond market is telling you that inflation is a thing of the past and that the Fed has done too much. And that's what I think likely drives trading for the next few months.
60-40 is back. That was the message from Brent Schutte, the Chief Investment Officer at Northwestern Mutual Wealth Management. Bonds are back. That was the message from David Baden of Citi, and I've heard that about 1 million times over the last couple of months.
So I'd ask which bonds and which stocks? Is it just a sort of uniform kind of indexing, or is it a disindexing or an unindexing?
Outdexing.
Outdexing.
When it comes to bonds, I think what they ultimately mean is treasuries.
Yes.
Treasuries are back as part of a 60-40 portfolio. When it comes to credit, I hear a lot about investment grade.
Yep.
Trading at 90 cents on the dollar, buy. Hear a lot of that as well. When it comes to high yield, that's where there's a bigger conversation. I think consensus view on high yield is that the quality of the overall index has improved markedly compared to what it was in years gone by, and the argument would be because of those factors that if we get a recession, a downturn, you don't get spreads as wide. The pushback comes from the people like Bob Michael at JP Morgan, who just thinks, hold on, if we get a downturn, spreads are going wider, and I'm going to wait for that.
Problem is that the rate aspect will probably come down. That's what people are betting. And so you already saw the rate sell-off, and now it becomes the credit sell-off. And if you believe in the credit sell-off, the deterioration in the overall economy, you don't want to own the most leveraged companies. And that's what you're hearing from a lot of people.
Equity futures right now, positive 0.25% on the S&P 500. Yields just a little bit higher to kick off trading this Thursday morning. We're higher by 3 basis points on a 10-year, 344.93. Coming up a little bit later this morning, 1 hour and 12 minutes away, we'll have jobless claims for you. I think it's you, Mitch, tomorrow. That's exciting, isn't it? You, Mitch. A couple of phone calls. How are you feeling about inflation?
You know, I'm going to call you from them just to make you feel included.
10%. They cut the tails off if someone comes in at 20. Does that get disregarded?
Are you going to try to game the system? I think inflation is going to be 45% next year.
25%. 25%. I'm in the hyperinflation camp when you, Mitch, calls.
You've just been blackballed from ever.
From you, Mitch. You, Mitch, are never calling me. Let's talk about something more serious than you, Mitch. Low bar. This from Vladimir Putin, the Russian president, talking of Russia's nuclear arsenal in the last 24 hours and saying the following: we won't brandish them like a razor running around the world, but we of course proceed from the fact that they are there. This is naturally a deterrent factor, not provoking expansion of conflicts, but a deterrent, and I hope everyone understands this. AMH in Washington, Maria Tadeo in London. Maria, your response to those comments by the Russian leader?
Jonathan, whether you think it's bluff or not, when Vladimir Putin talks about nuclear, you have to listen and you have to pay attention. Now, the response, of course, from Western officials, European officials, is that a nuclear war cannot be fought because it cannot be won. That's a level of destruction that you would see. I also know of European diplomats who are not even willing to use the word. The French president, Emmanuel Macron, he talks about capabilities. He doesn't even use the word nuclear here. But the two things that I would say, and this is factual, is that every time Russia encounters problems on the battlefield, Vladimir Putin likes to bring this issue up again. And then the second point, and perhaps obviously connected to this, there's a big debate about weapons for Ukraine, but the type of weapons for Ukraine. That means long range. That could potentially hit Russia. And maybe yesterday, that's actually the real message that he's trying to pass on. If you give Ukraine long-range weapons and Russia gets hit, then you've entered now a new phase in this war, and that means real escalation.
Maria, in this past week, I think there were some renewed hopes, and we've done this a few times in the last 9 months or so, that perhaps the US leader and the Russian leader could open talks. We heard from President Biden that he wasn't exactly shutting the door to it, and we heard from Peskov that Vladimir Putin would equally be open to it as well. Where are we with that kind of thing?
well, for the time being, is silence. And by the way, when you speak to the Europeans, Emmanuel Macron says he's also ready to meet with him if it takes this somewhere forward and you see a diplomatic solution. The problem is, at this point, it's Ukraine that will have to set out the terms. And the Ukrainians have been very clear that this is not the time for diplomacy yet, that they want to see more victories on the battlefield, and they remain, again, and this is incredibly important to stress, convinced that they can get everything back, and that also means Crimea.
How much, Anne-Marie, does this mean more weapons from the United States? How much is there a willingness to continue to pump money into this, given that there has been a growing amount of pushback?
At the moment, it is the same, right? The United States continues to send the aid. We just have text of the defense spending bill. You see the Republicans signing up for this, especially Senator Mitch McConnell. He is definitely behind this in terms of the defense and financial aid going to Ukraine. But of course, we do have in January a fresh new House. The Republicans have control of that. The individual that's likely going to be Speaker, Kevin McCarthy, we've talked about this. He said there's, quote, no blank check anymore. He's walked it back before, and it hasn't been that we don't want to send the aid to Ukraine. The issue had become we want more oversight on that aid and where that money is going. One interesting thing Maria pointed to that I just like to pick up on was the fact that when President Vladimir Putin talking about nuclear, potentially he's trying to signal about Ukraine making inroads into Russian territory, which we did see with those explosions not that far from Moscow. And what you hear from the United States is that they are neither encouraging that. They say that this is Ukraine's decision, but that is not something that they are actually encouraging. What the West is trying to do is they do not want escalation in this crisis.
Well, but that's a hard thing to do if you have potentially bombs that are hitting near Moscow. How much conversation is there, Anne-Marie, perhaps off the record, in the background, with the U.S. warning Ukraine against any kind of escalation that could lead to some sort of broader conflict, especially with the prospect of nukes on the table?
Well, they say that they are not encouraging this, right? This is not something they want, but we did have that Wall Street Journal report out that they had amended the range of those HIMARS. We also know that the United States has not gone to the next level in sending even longer range missiles. This is something they really want to do. They want to make sure that while, yes, they are helping Ukraine, sending the tens of billions of dollars, making sure they are getting the weapons, and also I just saw a headline about Estonia. Also, the United States is going to be helping and sending some HIMARS there. At the same time, they want to make sure they keep this centralized. They do not want this escalating, because once you have more of these missiles potentially going into Russia, that is a greater risk of Western countries, i.e. the United States and NATO, getting involved in this war. And Putin said yesterday he expects this to be lengthy.
AMH, just briefly, the president has done a pretty decent job of keeping his allies on side. I think a lot of people have congratulated him for that throughout this year. The other issue, Georgia, a win there, coupled with falling gas prices, this is Axios this morning, and a summer of legislative successes, it makes it more likely that the chief of staff will depart. Can you just weigh in on this reporting coming out this morning? Because I've heard that about 1 million times over the last 12 months.
Yeah, there's always rumors, especially going into the midterm election and then coming out of the midterm. What's the shakeup? These are really taxing jobs on individuals and their families. You work pretty much 24/7 around the clock. And that's what aides, according to this Axios report, are saying about Ron Klain. The president wants to keep him. A number of individuals, allies of the president, want him to stay in that job, but he's done it, I think, as Ron Klain I said in this Axios report, people familiar with the matter, that he said that he's been in this job longer than most of his predecessors. So potentially a shakeup for this incredibly important position. And the timing is the fact that there's a number of wins for the White House, that potentially he'd be leaving on a high note and leaving the president in a good position. The foreign policy stuff, we do know that Ron Klain has been obsessed with gas prices. That Washington Post article over the fall, the fact that he wakes up and the first thing he checks is the AAA gas prices. Now they're what? Below $3.50. This would be a good time for him to maybe say goodbye.
A two-handle is when he exits, Bramo. That's his strike price, apparently. That's a joke. I'm not being serious. Anne-Marie down in D.C., fantastic to catch up with you alongside Maria Tadeo out of London. Want to draw your attention to the story on Credit Suisse. Our latest reporting reads as follows. Banks handling Credit Suisse's rights offer expect nearly all of those rights to be exercised. Banks arranging the deal currently expect investors to take up well above 90% of the stock on offer. This according to the people familiar with the matter, asking not to be identified because the information is private. So things were looking pretty shaky in the last couple of weeks, and Lisa, it looks like that capital raise is going to be somewhat of a success.
You're not seeing, though, a pop in the shares. So I'm not sure what to make of this, because we saw a lot of volatility. The shares are lower in pre-market trading. A lot of questions around Credit Suisse, not from a will it implode, but what does it look like? What's its role going forward?
What do you want to be when you grow up?
Yeah.
It's often the question we ask about European banks and can't get answers. We talk about two handles. The fact that stock has a two handle.
I mean, it just shows you the lack of faith that people have had and the lack of conviction that they're going to come around with something.
Tough
It's been super
for that
tough
bank.
for them.
Futures positive 0.2% from New York. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
hours away from the opening, about 60 minutes away from jobless claims in America. Your equity market pushing just a little bit higher through most of this morning. On the S&P 500, futures positive 0.2%. On the Nasdaq, up 0.25%. On the Russell, the small caps, up 1/3%. That's the equity story. Picking up on the bond market, 2s, 10s and 30s. I want to talk about the two-year. The two-year right now, 4.2848. The yields are higher by about 3 basis points. Tom mentioned the BMO note yesterday from Ian Lingen. Upside risk to the two-year as it faces a 4.50 Fed funds rate and a higher summary of economic projections, higher dot plot at the Fed's meeting next week. We're at 4.30 right now, Lisa. I keep going back to a few payrolls ago, about a month ago. We got close to 4.80 on a two-year intraday. Back to way big time since then.
Yeah, and just a couple of minutes ago, Andrew Hollenhorst over at Citigroup came out with this. We have been perplexed by the fall in Treasury yields, which continued yesterday. Markets are pricing a terminal Fed funds policy rate about 100 basis points above current levels, but then a rising probability of cuts in 2023, despite all of the commentary to the contrary.
It's kind of bizarre, isn't it? I guess it makes sense for a lot of people. We're pricing in a higher terminal rate, but then deeper cuts afterwards. So however far they go, they've just got to sort of cut it all back in the months afterwards.
You can argue what this says about Fed credibility. The Fed is saying we're not going to cut. We're really not going to cut. We're going to hold them there for a long time. Again, even if we're dovish, we're going to hold them there for a long time. And people are saying, we don't buy it.
Is that a Fed credibility question, though? The reason I asked that, I think there's a difference between what they signal and what they think will happen with this economy. I think they want a signal type policy for a long time. I think they want a signal no interest rate cuts. But the chairman is telling you and told you at the last news conference, if we over tighten, we can correct that with interest rate cuts. He is telling you that's part of the playbook. That's in the
so
toolkit
annoying.
if we go too far.
We're saying this, but we're going like this and going like this. And it's like, come on, this is irritating.
It's part of the game, isn't it?
I mean, but if it's a game, then that's a credibility issue because then they don't have the trust in what they're actually trying to signal to markets.
It's not, exactly a game, but you know what I'm saying. I want to finish on crude just briefly. WTI, with the potential to close out the year negative, up on a session by 2.5%, $73 and about 80 cents on WTI. Brent crude, just a little more than $78 a barrel. What happened to triple-digit crude to close out the year, Lisa? What happened?
Just wait. It'll come. That's what a lot of people keep saying. And yet, here we are with China potentially reopening. I don't understand the story. I really don't. It's a really complicated one. I just want to bring up a couple of names that are catching my attention this morning. Rent the Runway. Take a look at those shares. They are absolutely skyrocketing this morning after reporting better than expected earnings, up more than 15%. It's fascinating to me as you see everyone go back to work, go back to going out with friends. This is a reopening story and how much they see subscriptions going up as people try to dress up a lot more and go out of the Lululemon pants.
Have you ever used it?
Yes, I have.
What do you think?
I think it's a lot of fun. I don't know that I have the attention span to really focus on it.
I thought it would go away. I thought it would go away after the pandemic because I
Why?
thought people would be a little bit weird about sharing clothes.
Well, I don't
That's
think
what I
that's
thought.
the case. I thought that
in the
people would be
pandemic,
weird.
and it's bounced back.
I see people who don't wear masks and cough all over other people. So, I mean, you would
Clearly
think
we
that
got back to normal.
we're back to normal. Also seeing a reopening story over from China. Yum China up about 3%. Wynn Resorts up about 3% as well. Macau is relaxing COVID testing rules for both Chinese and overseas visitors. So you're seeing a real pop in some of the casino stocks there. Just, again, you're seeing people buy into and kind of front run the reopening story. Is there a pain trade there if suddenly it's not as easy or as quick as perhaps some people think?
Stop-start. I wonder what it's going to look like, how choppy it's going to be in 2023. And we spoke to Damien Sassower of Bloomberg Intelligence yesterday. I think you've got to decide, is this about taking the next step towards a full reopening, or is this about just pleasing the people who went out protesting a couple of weekends ago? Do we actually get, by the end of 23, something that looks like a full reopening? And do we experience what ultimately we experienced in the West when we tried to do this, when we didn't have decent vaccine coverage because we didn't have a vaccine? You saw it in Europe. I was there. We were reopening, we were locking down again. I just wonder how much of that you get in China in the next couple of months.
There's an extra tension overlaid on top of this, not just the social pushback, but companies, and I think about folding in the Tesla news, that are saying, wait a second, demand is going down in China. Maybe we don't have to be as committed to being in that market as we have been.
Let's get to the bond market. Greg Staples joining us around the table, head of fixed income North America at DWS Group. Greg, always great to catch up with you, sir. A bond's back. Keep hearing it. Bonds are back. Bonds are back. A bond's back.
To be honest with you, I think bonds were back. I think they were pretty attractive in October. We've had quite a stupendous rally just over the past 6 weeks. We've come down 80 or 90 basis points from the high in the 10-year. We've tightened in credit with high yield and IG, and a space that I like a lot, mortgage backs have come in a lot. So I thought there were good opportunities back then. Now I'd pause a little bit. I think valuations are a little bit rich, and I think there's going to be a bumpier couple of months ahead.
As you look across the curve, where on the curve is rich, do you think?
I think the long end is rich. I think the 10-year Treasury through 3.5, probably through 3 3/4 is rich, and it wouldn't surprise me at all to test 4% as we go into the first quarter of 2023. You look at the fundamentals of the TIPS market, you're talking about break-even inflation now at 2.20. That's a real hurdle, as well as real rates, 1.1%, which I think long-term is probably a fair valuation, if not a little bit rich. So long end is rich. Short end, I think, is actually quite attractive.
So 4% Fed funds rate, what does that mean, or 4% 10-year yields, what does that mean in terms of the economic outlook? Does that mean that the Fed isn't going to go as far as people think, and that the inflationary impulse is going to be a little bit more protracted than a lot of people are pricing in?
We think as we get into 2023, the market's really going to settle in terms of long-term valuation for the 10-year. There's going to be volatility in between. But right now, we're not just looking at the next 2 or 3 months. We're looking at where we are in the end of 23 into 24. A lot of our clients are long-term investors. We want to put things into their portfolio that they're going to hold for a period of time. And we think fair valuation for the 10-year, once we emerge through the cycle of 2023, is in that 3 3/4 to 4 1/4% for treasuries.
That's kind of shocking to me, and I'll explain why. I'm looking at a credit market that's grown up under this idea that treasury yields would be around 2%. How does that get completely transformed as companies actually have to refinance in a 4% treasury yield environment? That is a completely different scenario.
I think there are a couple of things that are going on here. One, of course, is that QE is something of the past. So we don't have the global central banks buying a lot of those long treasuries, pushing treasury yields down. But we also think longer term inflation is going to be above the 2% that the Fed is targeting. It's something that the Fed's going to have to wrestle with longer term. 3% perhaps is the right number. There's a lot of fundamental things that are going on with the U.S. economy as we emerge from COVID. Think of the change in the composition of the labor force. Think about work from home, the gig economy, quiet quitting. It's going to make incentives to work a little bit different. Think about what's going on in terms of onshoring. You see the TSMC plant that broke ground yesterday. That's not going to be the lowest cost producer of chips globally. You're never going to get American-produced chips cheaper than you are in Asia. Think of all the investments that are being done on decarbonization. That's all going to raise basic global costs, and we think we're going to settle into a level of inflation that's higher than that 2% that we had in the late teens.
So we've had a multi-decade bull market in bonds, and in every cycle we've had lower lows in the Treasury market. Lower lows, in fact, lower peaks rather, in the Fed funds hiking cycle as well. Is this something that you think is going to change in the next several decades in the way it did over the last 3?
Well, of course, the obvious answer is yes, because if you extrapolate those lower lows, we'd get to negative rates because we were basically near the zero floor in 2020. And I think given the experiment that they had over in Europe, that's not going to happen again. No, negative interest rates, I think, are tossed aside as policy. And I do think that because of some fundamental structural changes, yes, you're going to see increasing rates, not back up to the 8 or 9% that we saw in the 80s, but I do think the market's going to get comfortable with 3% or maybe even 4% sovereign debt yields.
This is hard to answer, but just go with me and explore it a little bit further. Do you think in multiple cycles we could see higher peaks in Fed funds off the back of this? Is this something that feeds on itself over time? How do you think about that?
I think without the political environment changing, that's unlikely. I mean, if you truly talk about stepping in and cushioning some of the pain that we're going to have to go through with more fiscal stimulus, I mean, you look what's going on in England. They're talking about massive amounts of bond issuance to try and
because the pushback, to your point, you brought up the debt in England. The pushback to all of this would be, we can't do it, we can't stomach it, we've added too much debt. That was kind of what was behind the bull market over the last several decades. And the lower peaks in Fed funds in each and every cycle was this belief that ultimately this economy can't stomach it. Europe can't stomach it. The US can't stomach it. We've got too much debt. Do you push back against that?
I push back against that because I think the level of rates is not set by the supply and demand of debt. I think it's set about long-term expectations about inflation. And I do think that at that inflation-unemployment trade-off that the Fed has to deal with, they will settle for a higher rate of inflation if that means we can keep unemployment at the 4.5, which I think is the narrow rate, rather than, say, a 5 or a 6. I mean, if you're talking about a 6% unemployment rate, people will say, give me more inflation. It's okay if we can bring unemployment down. We'll take that pain.
Well, people are saying that it's been sort of shocking that the market as it is, given how much debt is out there, has survived and sustained itself as well as it has, and seems like this is actually an environment that could be protracted. But how does this change the sort of consensus view that credit could be a fertile and good place in upcoming years? Because the default cycle won't necessarily be that benign if you have a 4% 10-year yield for a longer period of time. That's not that far away from where high-yield bond yields were not that long ago on average.
Lisa, a 4% yield is okay if you've got 3% underlying inflation. That's a 1% real rate. Don't think of it in terms of 3% real rate. That's too high. I think corporations can't deal with a 3% real rate. But if inflation, if they're raising prices, they're able to pass that through, they're comfortable with 3% inflation, paying a 4% nominal coupon, and they can make the capital equation work.
Just real quick here then, do you expect stock investors to come to you instead? Stock investors who went for income to say, forget about it, bonds are the place to go, and actually to divert money away from equities and riskier assets?
It's going to be a real competition. If you can lock in a 4.5, 5% coupon on a bond or a bond fund versus what are we in the S&P dividend yield right now, through 2%, it's going to be pretty attractive for income investors. Yes, absolutely.
Are you busier this year?
Busier?
It's getting busier. Are you getting new clients that are coming to you in a way that maybe they didn't before?
Just within the past 6 months, it's been wonderful. To be honest with you, I've 7 years in the wilderness as a fixed income investor.
Yeah, that's what I thought.
And it's fine. It's great.
Full biblical.
I hear the same from PIMCO, from the PIMCO guys as well.
They're so excited.
It's like it's getting people are interested in short rates.
We're cool again.
You know,
Yeah,
I don't know about that. No, they're cool. Greg Staples at DWS. You're still laughing. Why?
Well, because you just look at me, you're like, you're not cool.
Well,
It's true, and I'm totally not.
Relatively speaking, I think the fixed income macro guys are cool, but it's like that's relative to other people in the market, right?
Carry on. Let's look at the markets. Let's move on. I mean, look, I think that it is fascinating when you get to see eyes light up when you start talking about yields and spreads and people start actually seeing value. It's a huge change, complete change.
Will it stick?
I don't know. I mean, honestly, this is the question, because so far we've seen a tremendous rally. You hear Citigroup's Andrew Hollenhorst saying it just befuddles him why there has been such an incredible rally. There are two sides. I mean, there's the Steve Major side, and then there's most other people.
Well, there's Greg Staples, there's Eric Nelson.
Yeah, most other
people that think that the long end is too rich. I've heard it a few times in the last couple of days. Even the guys at PGIM, Robert Tipp, same thing.
We're hearing that from a lot of people. It's not just a wholesale buy. It's a nuanced call.
Coming up, when we get jobless claims, after that we'll catch up with Kathy Bosjanczyk, the chief economist for Nationwide from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, the European Union has pronounced a 9th set of sanctions, and that's against Russia, and it includes restrictions on drones and much more chemicals and technologies used for military purposes. The measures were made public hours after Russia's President Vladimir Putin warned that the threat of nuclear war is rising. Bloomberg's learned that the Netherlands is planning new controls on exports of chip-making equipment to China that could align Dutch trade rules with U.S. efforts to restrict Beijing's access to high-end technology. Washington has been pushing its allies to join efforts to cut off China. Over in Peru, the country's 6th president in 4 years begins her first day in office, trying to build a cabinet and restore confidence in the economy. Dina Boluarte took over Wednesday after President Pedro Castillo tried to suspend Congress and call for a new constitution. Castillo's moves were described as an attempted coup. Congress voted to impeach him, and now he's being detained. Unilever is considering selling its portfolio of U.S. ice cream brands. Bloomberg's learned that brands such as Breyers and Klondike could bring in as much as $3 billion. Now, international labels, Ben & Jerry's and Magnum, wouldn't be part of the deal. CEO Alan Jope has indicated Unilever would look to divest certain underperforming businesses. And more than 1,000 New York Times newsroom workers began a one-day walkout today over a stalled contract. That's according to the New York Times, which says that the company and the New York Times Guild have failed to come to an agreement on salaries, health and retirement benefits, among other issues. Employees have been without a contract since March of 2021. It's the first full-day work stoppage at the Times in about 40 years. Global news 24 hours a day on air and on Bloomberg Take. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Look, a recession is not a question of if, it's a question of when. And we do think that a recession will come at some point, maybe in late 2023. The point is that between now and then, markets still experience very large fluctuations, both equity markets and credit markets.
That was Alessio De Longis of Invesco with a very, very different view going into 2023. He was talking about overweighting equities yesterday, increasing risk. They're saying the recovery trade is right now.
Well, and talking about how perhaps the base case, the consensus is wrong, and that what happens if this recovery or if this sustained momentum lasts for longer than people think, and we don't get that downturn until perhaps the second half or even first half of 2024.
Equity futures right now up 1/3% on the S&P. As I keep saying, 5-day losing streak coming into Thursday. Can we erase some of that at the opening bell? That might depend on what happens with jobless claims about 43 minutes from now. Yields are higher going into that, up by another basis point or so in the last 10 minutes, up another 4 basis points on the session to 346.20. Euro dollar not doing much, 105.22. Slightly stronger euro, weaker dollar, and crude trying to bounce back by 2.5%, almost $74 a barrel on WTI. And after yesterday and the day before, negative on the year so far. Let's see if we can change that going into year end, even with this China reopening story. This from the Communist Party's flagship People's Daily, local newspapers across the country echoing this theme. Here's the quote from some commentary. In the past 3 years, the virus has become weaker, but we have become stronger. Lisa, it goes on to read, we got through the most difficult moment. Are we truly on a path to reopening in China?
Does the market buy that we are? On the margins, yes. It's going to be rocky. It's going to be fits and starts. What does reopening look like? I mean, we talk about the idea of reduced testing, but you still have to be quarantined if you've got contact with somebody who's got COVID for a serious period of time. So I don't understand exactly the nature of what the reopening actually looks like.
And let's get to Tom Orlick on that. He joins us now, the chief economist for Bloomberg Economics. Tom, what's your read on what's developing in China in the last couple of weeks?
So, Jonathan, if you'd asked me a few weeks ago, when is China going to make the substantial pivot towards reopening, I would have said, best bet, March 2023. Get through the winter, get vaccines into people's arms, then reopen. Well, I've been surprised. They've moved substantially earlier than that. The pivot is already here. You read about it in the People's Daily today. But going forward, it's going to be far from smooth sailing. We know from the experience around the world that when you reopen, infections rise, and sadly from there, hospitalizations rise, and yes, deaths rise as well. China hasn't got to that moment yet, but it's coming in the next few weeks. And when it does, there's the potential for another pivot. Does China double down on reopening and say, we've come this far, let's finish the job? Or is there an attempt to reimpose controls to contain what could be a public health emergency? We don't know what's going to happen at that moment. And until we do, it's hard to make a definitive call on the outlook for China's growth, or global inflation, or what the Fed's going to do in 2023.
So, Tom, if I gave you a pen right now and asked you to draw a chart of what you think GDP is going to look like through 23 in China, does it do a lot of that? Up, down, up, down, up, down, stop, start, reopen, close, reopen, close?
So I've given China's government a lot of credit for their capacity to control the virus over the last 3 years. Yes, it's imposed an enormous cost on China's population, and we saw that bubbling up in the protests in the last few days, but they've been hugely successful at saving lives. Just a few thousand people dying from the coronavirus in China so far. My question going forward is, well, can you be half locked down? Or is there a point where the virus has just spread so far that actually returning to lockdowns isn't possible? And so is the path from here just a reopening one? Now, if that's the case, if you take reopening and the boost that gives to GDP, if you take additional support to the property sector, which is already moving into place, and if you take a low base for comparison in 2022, then for 2023, we could be looking at Chinese growth in around the 5% mark.
Tom, we talked about how the protests possibly helped accelerate this process. Is that really what's going on, or is it also that you're seeing international corporations pull back from China? We saw this morning Tesla, for example, shortening some of the production hours of one of its factories in Shanghai. It's not alone, and it's not because of the supply chain disruptions. It's because of a lack of demand in a subdued Chinese economy. How much is this at the forefront of the minds of the People's Bank of China and also the Communist Party?
So there's been a remarkable shift in the global view on China over the last few years. I think heading into the sort of the pandemic period, there was still a lot of optimism about a Chinese economy with huge growth potential, with a government that basically got it on the importance of markets and opening, and on all the opportunities that brought for business and investors. If you look at the situation today, you've got businesses who can't get their executives into China. You've got businesses that can't sell in China because of lockdowns. You've got the drag on growth and on sentiment from the property lockdown. And the global view on China has basically swung from quite a lot of optimism to quite a lot of pessimism. Now, it seems like that message is starting to get through in Beijing. And so after that party congress, that crucial moment in October where Xi Jinping got installed for a third term and got his loyal followers into the standing committee, we've actually seen a series of moves which look aimed at addressing that pessimism and turning it round. Exiting COVID zero, more support for property, and that Xi-Biden meeting, which put a bit of a flaw under the crucial US-China relationship.
Is it too late, Tom?
So China's got some really big structural stresses, Lisa. They've got a demographic drag with a shrinking working age population. They've got a huge burden of debt. They've got massive overcapacity in real estate and in industry. And the global environment looks pretty challenging. We've heard today that the Netherlands potentially will join the United States in blocking sales of semiconductors to China. But let's not forget that China has a track record of defying the doubters. In Beijing this week, we've had the memorial service for Jiang Zemin, one of Xi's predecessors as China's president. Jiang took over at a moment of peak pessimism for China in 1990. Over the course of a decade, he turned that round, made China into a kind of global growth darling by the time he exited in 2002. I think there's a lesson there for people who are counting out China today. They've defied the doubters in the past. Let's see if Xi can do that again in the 2020s.
Well, the West helped make that happen, didn't they, in a major way over the last 20 years. Tom Orlick, thank you, sir, as always, from Bloomberg Economics. Amazing how much things have changed, to Tom's point there, from the Chinese Communist Party. And if you were to ask when we'd get that reopening, I think many people would agree with Tom, perhaps the end of the first quarter in 2023. This is what the People's Daily said in mid-November, that China could achieve, quote, dynamic COVID zero, going as far to say that it would help rather than hinder the nation's development. A few protests later, and here we are.
There's also the issue, and this is something that we were just hearing from Tom, can you partially reopen? Can you have partial lockdowns? If you start getting an incredible spread of virus case counts, how do they handle that? How do they handle that with the hospitals? How do they handle that? Why are they not opening up to certain mRNA vaccines that have been proven to be more effective and make it a mandated policy to get it into everybody's arms?
And to be clear here, it's not clear how many people have actually died in China from COVID. We have the reported statistics from the country. There is suspicion that it's a lot larger than that. And I think the lesson actually over the last couple of weeks is, despite the fact that this is an authoritarian state, they didn't respond to those protests in a way that I think some people thought they might, with strength, just coming down, beating people back. They've actually had to fold and capitulate on just around the edges on COVID zero. And it's why I go back to what we heard in that People's Daily commentary this morning. It's radically different to what we heard just a month ago.
This isn't just one protest, though. It is so unusual to see many different protests in China. This is something that harkens back to the Tiananmen Square issues in 1989 and the protests there. And perhaps that's part of it. I keep going back to the business side of things, too, though. This is also their international standing at a time when the economic data is really deteriorating. There are two prongs here.
I think, to Tom's point as well, for growth next year, trying to make a call on Chinese growth. Do you see a smooth reopening or a volatile one? Stop, start, in the same way we did in Europe and elsewhere, in America too?
Do you emphasize the international business picture as well? Because that would be a change as well.
Jim Paulson of the Luthold Group is going to join us shortly on this equity market. 5-day losing streak on the S&P, trying to prevent it from becoming 6. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Once we get into a recession, things can break unexpectedly.
There's no question wages are rising, prices are rising. That is likely going to take a recession to bring those inflationary forces back down.
Liquidity is dried up, and when liquidity dries up, you get incredible volatility coming out in the market.
The bond market is telling you that inflation is a thing of the past and that the Fed has done too much.
We do think that a recession will come at some point, maybe in late 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
That time of the year where you're just itching to say year's over, things start to churn.
That
you know
happened
what I mean?
a while ago.
CPI next week, then the Fed decision, and you just
Yeah.
get the feeling that after the Fed decision, that news conference finishes, it's like year over, let's go home.
Are you saying that the ECB meeting doesn't matter? Is that what you said?
I'm saying that for
Wait a
me, it might
second.
be year over,
Wow,
let's go home after the
All
Federal
right.
Reserve. Live from New York City this morning. Good morning with Lisa Abramowitz. I'm Jonathan Ferro. TK back with us in a couple of days. Equity futures picking up, 5 days of losses on the S&P, and we wait, don't we? We wait for the next catalyst, and that catalyst comes next week.
Yeah, we get the CPI report, and then we get the Fed meeting. Everyone seems to be waiting for that. It's been a light week of data, and it's been range-bound, but there has been a shift in tone. This week has been notable in that yields have gone lower, and that did not push stocks higher. And to me, that's a huge signal that we have shifted narrative into a slowdown, not necessarily into some sort of stimulative effect of lower yields.
Is the oil market part of that story, for you at least?
I mean, you could draw it into the narrative based on the price action. I don't understand the oil market. I don't understand how some of the ongoing Strategic Petroleum Reserve releases are factoring into this. I don't understand how some of the poor liquidity in this market is factoring into this. I don't understand how China's reopening hasn't given more of a boost to oil prices. There is, though, still more production that's being made from a lot of oil companies at this point. So I honestly don't know.
I still don't understand the oil cap, for what it's worth anyway. Futures look like this on the S&P 500. On the S&P, we're up by 0.4%. I've had 10 people explain that to me, and I'm like, does it make a difference?
Well,
come on.
But that's a good question, because there have been reports about Chinese buying oil from Russia at $79 a barrel. So
$74 on WTI right now, into the low 70s. Ed Morse, we said it a million times over at Citi. What a call to push back against this triple-digit stuff going into year-end. That's crude. Euro dollar positive 0.1%, 105.16. To Lisa's point, the year is not over for the Europeans. After the Fed decides, it's the ECB's turn next Thursday. And just to round things out, yields are higher by 4 or 5 basis points, Lisa. Still sub 350 on a 10-year, 346.20. Greg Staples at DWS about 20 minutes ago on this program. He said that maybe the bond market, parts of it, a little bit too rich. I said, where on the curve? He said the long end. Not the first time I've heard that this week.
people saying that the rally's gone too far, talking about, Greg Staples was talking about a 4% 10-year yield over the next decade, that's basically going to be the new base.
The new floor.
That new floor.
I heard that from Wells Fargo too.
But how much does that rearrange a market that has been predicated on low rates?
We haven't capitulated on that view, I don't think. I still think there's a consensus view around tech stocks. I still think there's a consensus view that yields have to go lower, that rates are going south. We're going back to the old playbook of the pre-pandemic, and we've heard pushback on the bond side from Greg, on the equity side as well from Savita Subramaniam over at Bank of America, who just had some strong words yesterday about tech, that we've just been conditioned by the gains of a decade, and we're still kind of like just there itching to get back in, and she's saying that's got to go, that's got to go away.
Has transitory really gone away?
You don't think it has?
I don't. I think that people think it's just been prolonged, not necessarily discarded, that eventually there will be this disinflationary force that will overtake. There isn't necessarily as much consideration to structural differences that are going to cause inflation to be higher.
I'll let the data speak for itself next week. CPI on the 13th. Jim Paulson joins us now, Chief Investment Strategist at the Luthold Group. Jim, your words. I think a new easing cycle has begun. Now, Jim, some people might be scratching their heads and saying, Jim, I don't know if you know, but they're going to hike 50 basis points next week. What are you talking about? Jim, what do you mean by that? A new easing cycle has begun.
Well, Jonathan, the Fed is not the only policy driver in the room. There are others, and a lot of those have already started to ease, I think, and they don't hold press conferences, but it still matters. And I think, you know, if you go through the list here, we still have the Fed. They're going to raise rates again. But if you look at what the bond market's doing, everything even from 2 years out, they're all easing. We got 75 basis points ease in the 10-year. Mortgage rates are coming down as well on the long end. That matters. That matters immediate support for stocks, but also longer term for the economy. Fiscal juice, if you look at federal deficit to GDP ratio, that's rising again after going down for months, almost 18 months. It's starting to improve again as economy slows, tax receipts slow, automatic expenditures go up, and fiscal juice expands. The dollar's starting to ease after a tightening for all of this year. And that matters certainly too overall. And then you get into things like companies. Look at what companies are dealing with. They're seeing industrial commodity prices that have come down 20–25%. They're seeing unit labor costs decelerating as per yesterday's report. They're seeing capital costs coming down. So everything from commodity to capital cost to labor cost are easing for companies. Look at the consumer. They're seeing gas prices at the pump fall from over $5 to heading towards $3. The real wage rate has risen 3.2% annualized pace now in the last 5 months. As inflation is moderated, real wages are rising again for the household sector. You look at credit spreads, junk spreads or mortgage spreads, they're starting to tighten again, which is, again, an easing mechanism, if you will. So I really think there's quite a bit of early cycle easing, and I think the Fed's story is about over too. I think they're just getting increasingly out of bounds, raising rates with falling commodity prices, raising rates with decelerating headline inflation rates, raising rates with decelerating unit labor cost, raising rates in a slowing economy. I think they're going to have to be wrapping it up pretty soon.
So, Jim, what's your S&P target for next year? Is it 6,000? Is it 5,000? I mean, this seems like a very bullish scenario that goes against a lot of consensus.
Well, you know, Lisa, I think that if you think the bear market is not over, I get that, and that's one thing. I think the lows are in. And I think we're starting a new bull market. And new bull markets don't go up 7 to 10% in year one. They go up 25, 35% in year one. That's what new bull markets do. And I kind of think if we avoid recession, which I still think the odds favor, maybe 60-40 that we do, or if we have a modest recession, that the stock market is into a new bull market. In the first year of bulls, earnings don't do well at all. They're generally flat. They're often down. But what really happens is multiples go way up. And I look back since 1990, the first year of bull markets, the average trailing PE multiple rises by 35% on average. And if I look at, let's say earnings go to $220 or even $215 in the next year, but the multiple goes from its low at the bear market low of around 17 up to 22 or 23 times, it gets me to around 5,000. And I don't think that's all that unreasonable. I'm very interested that the strategists on the street, their forecaster, are virtually no gain at all over the next year. And I don't remember, there's not a lot of years when people are looking out. Strategists are usually optimistic, that they're this pessimistic. And I think if that's wrong and we are past the bear and we have a modest or no recession and starting a new bull, I think the returns could be really pretty phenomenal, something around 5,000 in the coming 12 months.
Wow. Jim, you're a student of market history. Can you tell me how rare it would be to make a low in the equity market this far ahead of a recession that we still haven't had?
Well, I look back at this going back to 1945. I think there's been 11 recessions, Jonathan, and I look back at what was the response of the stock market during each cycle prior to the beginning of a recession. And so from the S&P 500, from its cycle high to for the month right ahead of the start of the recession, how much had the stock market responded to recession risk? And the median response of those previous 11 was 5.5% decline from its cycle high. Here in this cycle, we're already down more than 25% from the cycle high. That's how much we already adjusted for a pending recession. So I think that part of the fallout, if you will, from a recession is already in the stock market. And so even if we have one, I'm not so sure that necessarily means it has to go down. I'd also say I don't ever remember another time when the CEOs in this country are almost 100% universal that we're going to have recession. Usually recessions are something that comes out of left field and it surprises the market. That's not going to happen here. People already have it in the market. So I think it's a very different situation overall. The same thing with yield curves. I've looked at that, and inverted yield curves, which lead to recessions, and we could get one here. But the fact of the matter is the negative fallout for the stock market depends on when the curve inverts. And the ones that turn out bad for stocks is when the curve inverts and the stock market is near its high for the cycle. This curve inverted in October when the stock market was already off 25%. And when that happens, the stock market does okay. And so we'll see what happens. But I'm more on the side that there's too much pessimism, too much has already been discounted, and that opens the door for a positive surprise, and people have to catch up.
Hey, Jim, this is quite a call. It's fantastic to get you with us on the program before year end, and hopefully we can catch up before Christmas again. Jim Paulson there, the Luthold Group. What a call. Here's some news for you. Reports coming across the United States. We're getting the confirmation of it here at Bloomberg. I'm sure you're very familiar now at this point with Brittany Griner, the WNBA star, who's been held for months in a Russian prison on drug charges. She has been released, according to a White House official. Reports suggesting there has been a one-for-one prisoner swap with Russia, Lisa, for an international arms dealer going the other way.
And this has been something that's been discussed for a while. She's going to be released in return for Victor Bout. That was the international arms dealer. And then she's going to undergo a medical evaluation as per protocol once there is a release.
We'll catch up with Anne-Marie briefly on this, I'm sure, in the next couple of hours. We're also going to hear from the president. The president's set to speak at 8:30 Eastern Time. He will deliver remarks from the Roosevelt Room. I'm sure we'll take that right here on Bloomberg TV and on Bloomberg Radio. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Saudi Arabia, China's President Xi Jinping met today with Crown Prince Mohammed bin Salman. The Saudis are the world's top oil exporter, and China is their biggest customer. But both are looking to diversify their energy mix. As part of Xi's visit, Chinese and Saudi companies signed investment agreements for green hydrogen and solar energy. Ukraine's President Volodymyr Zelensky is warning of prolonged power shutdowns due to Russian attacks. In his nightly address, Zelensky said capacity was constantly being expanded, but it won't be possible in the short term to return the power grid to its pre-war state. Hong Kong has taken another cautious step toward a full reopening. The city has shortened the isolation period for people who test positive for COVID and their close contacts. Plus, inbound travelers will be required to take 2 fewer rapid tests. Hong Kong has been slowly rolling back the COVID rules that have kept it isolated from the world throughout the pandemic. President Biden will announce a $36 billion bailout for a struggling Teamsters union pension fund today. It will help shore up one of the nation's largest multi-employer plans. And it will deliver help to the president's union allies after he angered many in organized labor by signing legislation imposing a contract on railroad workers. ExxonMobil is taking some of its record profits and boosting its share buyback program. It will now repurchase $50 billion of stock through 2024. That compares with a previous plan to spend $30 billion through next year. Exxon's second and third quarter earnings, well, they were the highest in the company's history. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Live from New York City, equity futures just about positive on the S&P in about 14 minutes. We'll get you some data. Jobless claims in America coming up. Almost called them international jobless claims. I'm not sure why. Anyway, whatever.
They're treated that way.
Up a third of 1%. They are treated that way indeed. Yields are higher by 5 basis points on a 10-year, 346.74. Moments ago, bit of breaking news. We can cross over to DC and catch up with Anne-Marie for that. Morning, Anne-Marie.
Good morning, John. Yeah, some really big breaking news coming out of the White House this morning, and this is really a culmination of months of work from this administration in their dealings with Russia, and this is the release from a penal colony of Brittney Griner, the WNBA star. She was arrested in February for having cannabis oil on her possession and luggage at a Moscow airport, and then she was sentenced to 9 years in prison. Most recently was moved to that penal colony, and we know that the United States over the summer put forward this plan to the Russians, a potential proposal for her and Paul Whelan, and they're only getting Brittney Griner out now, so I'm sure that's a question that we put to the president when he speaks in about 15 minutes or so. He will be speaking from the White House, but what they did exchange, who they did exchange Brittney Griner for is Victor Bout. He's a very well-known Russian arms dealer. He was serving a 25-year sentence that's now being cut short out of the United States. I mean, this is an individual that his nicknames are the Merchant of Death and the Sanctions Buster. But there's been a lot of pressure on this administration to bring home WNBA star Griner, to bring home Paul Whelan, who is still in Russia, as they did with Trevor Reed in April.
How did they decide on Victor Bout, who is this international arms dealer with these nicknames that you talk about? How is he the one that they decided to release?
I think a lot of this you have to remember is, well, first off, a lot of these meetings and the proposals, so much of it is clouded in secrecy. This is something U.S. officials do not want to discuss when you ask them about the status of these individuals because of their safety, also the potential that any leaks could ruin the deal. But you have to remember the United States is only one side of this agreement, right? So I imagine when it comes to Victor Bout, this is an individual that the Kremlin wanted back.
AMH, great to catch up. No doubt we'll talk to you in just a moment. In about 12 minutes' time, you'll hear from the President of the United States. We'll take that address here on Bloomberg TV and on Bloomberg Radio. The latest on Tesla, just want to turn to that briefly. Stock's been trading softer through most of this morning. Tesla at the moment, the latest news from us, will shorten production shifts at its Shanghai factory as soon as Monday and has delayed the onboarding of some new hires. According to people familiar with the situation, Tesla's stock at the moment is down by about 1.6%. Dan Ives joins us now, Senior Equity Research Analyst over at Wedbush. Dan, your thoughts on this story that came out moments ago?
I think you're starting to see a bit of a demand issue in China. And that's something that I think Tesla's adjusting to. I still view it more near term, not a long-term systemic issue. But look, after a Cinderella story, that they're starting to clearly hit some hurdles in China.
Does that extend to Apple? Is that a Tesla problem or a broader problem?
I think it's more of a Tesla problem right now. I mean, Apple, right, if I look demand to supply, still about 3-to-1. Their issue continues to be supply, Apple, not demand. And I think that's why the stock still continues to hold in there because of what we're seeing on iPhones globally. I think for Tesla, look, it's competition in China. They continue, I think, be in a very strong position. But you're starting to see cracks in the armor, and they need to adjust, and that's what you're starting to see here. But our thesis for 23 in terms of 2 million units globally continues to stand.
Others would start pushing back on that. We heard from Morgan Stanley downgrading their view of Apple as a result of some of the suppliers discussing a drawdown or a decline in some of the demand side. Is the lack of demand in China giving a pass to tech companies to start to divert business out of that nation a little bit more, especially in light of the turmoil we've seen over the past few years?
Yeah, Lisa, I think specifically for Apple, I mean, clock struck midnight in terms of what they've seen in China because of the Foxconn situation, the zero COVID. You're seeing a little loosening of that. But I think, it's really been a disaster in terms of Christmas. We're going to see about 10 to 15 million shortages because of what we're seeing in China. So I do think you're going to start to see diversifying out, potentially India, Vietnam, and others. And I think you're starting to see a changing of the tide there in terms of what we've seen in China the last few months.
So if you think that this is more of a Tesla story in terms of competition in China, lack of demand at a time when that really had been a bright spot, how much is this pressured even further by this idea of a margin loan to Elon Musk to back Twitter, to refinance that's like backed by Tesla shares? I mean, just basically leveraging up some of his holdings.
Selling diamonds to buy a $2 slice of New York City pizza. I mean, it's essentially the problem with the Tesla story, using it essentially as an ATM machine. And I think that's really been an overhang on the Tesla story. The frustration continues to build because of, the Twitter circus show. And I think right now it's not what investors want to see at a time where demand, especially in China, this is finally a storm that Musk needs to navigate Tesla through.
So, Dan, why are you still at 250 on the stock? Outperform?
Because, I mean, my view is the 2023 and 2024 story, that's still 2 million units. I still view this as more of a soft patch, not the start of what I view as a broader structural issue. And in terms of EV, I mean, I think we're going to see that in terms of adoption double in China over the next 2 to 3 years. Tesla's going to be a big, major part of that. I just think for right now, it's been a magic carpet ride, and they're finally hitting some uncertainty. They need to navigate through it.
What did you make of the Apple delay when it comes to vehicles and autonomous driving? What did you make of that?
Look, I think writing is on the wall. I do think that the China situation's throwing a lot of those strategic plans, I think potentially out in terms of what Apple's dealing with. And I think right now, juggling a lot of balls. I think first, strategically moving out of China is number one. And also, I think, look, the demand story in terms of overall EVs and autonomous, this is not the top priority for Apple. That's why I think that's pushed out. But I think, as Gurman's talked about, still believe that the Apple car will come, even though it's probably delayed by another year.
Do you think that there is overly pessimistic views around Apple, around big tech more broadly, as not being able to be the drivers of the next cycle? We keep hearing about that again and again. The de-indexing. I'm never going to get this right. What did
Didn't she say it was outdexing?
Outdexing. Basically throwing out
versus
some of the big
indexing.
tech. Yeah. Okay. So throwing out some of the big behemoths. Do you buy into that story? And if not, how do you push back?
Look, the New York City cab driver right now is bearish on tech. And I think that's sort of the trend here. My view is that that's still not going to change over the coming years in terms of tech leading. I think the market higher, because this transformation that we're seeing, a fourth industrial revolution, is not ending. I think it's just more of a shift. And I still think a lot of these tech names are oversold here. They're clearly going through a correction, as we've seen, which has been brutal. They're cutting costs, but growth on the other side of this, I think, continues to be robust. But it's as underowned as I've seen tech since 2010.
Dan Ives of Wedbush. Dan, there's a call at the end, Lisa, for you.
I'm just sitting here thinking about that
You're
versus
speechless.
5,000 on the S&P within 12 months, which we just heard from Jim Paulson. So much bullishness, basically saying it's the most underowned area that it's been going back to 2010. Big tech, which a lot of people are saying you need to unindex. I'm never going to get that right. I'm sorry.
People aren't enough to say maybe for good reason. Maybe for good reason. I want to get back to some news of the last 20 minutes or so. There has been a prisoner swap, 1-for-1, between the United States and Russia. Brittany Griner, the WNBA star, who I'm sure many of you are familiar with now over the last couple of months, detained in Russia on drug charges, has been released for an international arms dealer from Russia going the other way. We're going to hear from the president in about 5 minutes' time, Lisa. What we heard from the president so far out on Twitter. Moments ago, I spoke to Brittany Griner. She is safe. She is on a plane. Lisa, she is on her way home.
It's notable this comes at a time of escalation between the conflict with Russia's war in Ukraine, that there still is this swap that's being had and being made. And there was a lot of discussion around Brittany Griner's family not wanting to overly politicize this because they didn't want this to get caught in the crosshairs of the conflict right now. And yet there are going to be questions around some of the discussions around this in terms of what the U.S. is giving up and what the Russia is getting.
It will be controversial. In fact, it is controversial to see a WNBA player come one way and an international arms dealer go the other way. But that's been the nature of the negotiations for the last couple of months. This is the direction it was going in.
There are highly political reasons, and it's a symbolic kind of move for the U.S. to support their own internationally, especially for an international women's sports star. So there is a question of how this is going to be cast. You are correct. It's not a simple deal, clearly.
A briefing from the president 5 minutes away. We'll take that right here on Bloomberg TV and on Bloomberg Radio. Coming up shortly, Colin Marden and Charles Schwab, Kelsey Barrow of JP Morgan, Dan Skelly of Morgan Stanley, and we catch up with the PGIM COO, all in the next hour on Bloomberg TV as we count you down to the opening bell.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz. Tom and John are both. Tom is off. John is off preparing for the 9 a.m. hour. Just moments away from some breaking news as we await the initial jobless claims that typically comes around now. Michael McKee graces through the door as he prepares for that. The market's trying to stage a little bit of a rebound, but it is meager after a week of losses, 5 straight days, and we are seeing yields continue to creep up a little bit after having come down pretty dramatically over the past few weeks. Right now, let's get right to Michael McKee with the data. Mike.
Well, we can make this fast, Lisa, because I know you got a lot of breaking news out there right now. Initial jobless claims come in virtually unchanged from the prior week, 230,000. That was the expectation, so not going to set anybody's hair on fire with those numbers. Continuing claims did rise 1,671,000 compared to 1,608,000. Shows that people are taking a little bit longer to find jobs, but that number is still pretty low. So overall, this report doesn't move the needle a whole lot on anything for the Fed or on the labor market. We do have to caution, though, Lisa, that this is the holiday period, and it is very hard to seasonally adjust for the continuing claims number for the week of Thanksgiving. So there were a couple of days off where people weren't going to be going and filing for claims. So it's a time of year where you can't put a whole lot of stock in what we're seeing other than in the broad general trend, which is not bad.
And markets, you can try to say that things did tick up in terms of the S&P and NASDAQ futures, and you did see a bit of dollar softening. You did see yields. I don't know that you can say that they actually went anywhere on the back of this. I am wondering, Mike, whether there is relevance between these behind these initial jobless claims that we get, given that they are less and less traded and less emphasized.
Yeah, I think they're nowhere near as relevant as they used to be, and what we watched coming out of the pandemic and the big shutdown, we're kind of back to where we were pre-pandemic, with very low jobless claims and very strong labor market. And to the extent that they give us an idea of what's going on in the labor market, it shows that we're not seeing a major change there yet, even if people are predicting we're going to get one eventually.
Michael McKee, thank you so much. It is always great to see you, even if this is not exactly the indicator that people want to trade incredibly actively. Tomorrow, yes, and next week it will be a very big one. I do want to just let you know we are awaiting a press conference from President Biden in the United States after the announcement of this release of Brittney Griner, who is a 2-time gold medalist, women's basketball star, who was released in a prisoner swap with an international arms dealer with Russia. We are going to build on that, and we will bring that to you when we get it. We do want to dig more into the labor market, into the question about how far along we are in this disinflationary moment. Kathy Bostjancic, chief economist at Nationwide, joining us right now, who's been incredibly on top of the tightness of this labor market and how quickly it could potentially loosen. Kathy, how much are you starting to see true signs of softening, of loosening in a market that has consistently surprised to the upside in terms of how hot and tight it is?
Good morning, Lisa. Happy to be with you. We're not seeing a lot of loosening, and I think that's
actually, on one hand, good news, right? But on the other hand, for the Federal Reserve, not what they're looking for. They really do want and need the labor market to loosen. Not that they necessarily want to see jobless claims or people become unemployed, but what they'd like to do is take some of the air out of the market, right? That the job openings relative to unemployed still really high, running around 1.7. Wage growth accelerated. Actually, GDP growth looks like it's accelerating in the fourth quarter. This is going the opposite way, at least for now, what the Fed desired. They want growth to slow below potential. So that means GDP growth below 1.8. We're running a little bit above 3% for fourth quarter. So there's more work to be done, and I just think it reinforces for next week that we hear from Chairman Powell. Yeah, they will dial back to 50 basis points. That seems to be in the card in terms of rate hike, but they still need to sound a bit hawkish. They don't want to scare the markets, but they do need to lift rates at least to 5%.
Do you buy into this idea that we are seeing more disinflation than the data can possibly show now because it is a backward-looking indication? People point to dealer views on car sales next year. People point to a lot of different goods, including even some food that's starting to get a bit disinflated. They point to gasoline prices. They even point to rents. Why is that not all coming together with a feeling that perhaps the Fed is getting what they want in terms of a disinflationary rollover effect that will help them?
We're on the way, we're on the right path, and particularly in the goods sector. In the service sector, that's where the issue is, right? And that's where their services are very labor intensive. So coming back to the labor market, you need to see wage growth slow in order for service producers to be able to pull back on their increases. And as long as the consumer stays strong and willing to pay, we're still kept, in this inflation sort of dynamic. I think what you have to see is labor market wage growth slow. And what, the market applauded the fact that unit labor costs were a bit cooler this week, but we really need to see that be extended and maintained. My concern is that companies will start to lose a little pricing power, just as you said, some goods and even a little bit of services losing some pricing power, but at the same time, input costs, labor costs still running high. That's a profit margin squeeze, right? And that's, the equity market's not really priced for that. Nor is the bond market, frankly, priced for the Fed to go to 5% and hold it there for all next year. As you know, Lisa, bond market's still pricing in some easing next year.
So people would say, what's the market seeing that the Fed is not, that economists are not, that the market tends to be a forward indicator? And to your point, right now, there is a huge dissonance between what economists say, what the projections are for where the Fed funds rate should end up, and what you see with respect to margin compression and what you see with respect to yields. What gives? Who's right? How do you know?
Well, ultimately, we don't know, right? But it's the fundamentals suggest that the equity market has gotten ahead of itself, even the bond market. From what we hear from the Federal Reserve is they're very resolved and resolute to make sure that inflation comes down. Even though we're seeing these disinflationary forces come into play, it's not enough yet to get us back towards the 2% target level with confidence. And I think that's what the Federal Reserve is saying. We really want to be confident we're back to 2%. Just because we go from 7%, 7.7 on it, let's say headline inflation down to 5%, that's still not enough. So we're in the right direction. And I think that means that the Fed doesn't have to raise rates to 6% or higher, but it doesn't mean that, they're ready to start to pause or even cut rates, looking into next year.
As we talk about what's going on with the labor market, we are awaiting a press conference from President Biden on a prisoner swap after releasing Brittany Griner. We will bring that to you when he does come out with those comments. He did say that he has spoken with her and she is safe. Kathy, we're talking about the likelihood that the Fed is going to raise rates a lot further than people expect, that perhaps the equity market is going to see a bigger downturn as a result of margin compression. I am wondering whether the structure of this market has been surprisingly resilient to you, given how much debt has been incurred over the past few years, over the past decade, and the idea that it's been predicated on low rates. People thought that it would break. It hasn't. Does that give you confidence, or does that make you think that it's just a matter of time?
I think the debt situation, because rates were low for so long, it actually allowed companies to lock in for a long period of time. So I was never really overly concerned. I mean, there's certain sectors, the tech sector, which is already been repriced because they rely on debt and that not able to lock in for as long a period of time. But if you look at the maturity wall that people talk about, it's at least 3, even, maybe 5 years away from now. So not overly concerned about that. And I do think, once we get past this period, I think we go back to low interest rates. I'm just saying that for 2023 seems to me the market is premature in thinking, this is all behind us. I guess the idea is, you were talking about this earlier this morning, it's an unusual period, right? We've never seen a recession so anticipated. And it does make you, I spent a lot of time on Wall Street. It does make you seem to think, well, maybe I should take the other side of that and bet that a soft landing is more likely now. But again, you come back to those fundamentals, it just doesn't seem to add up. The recession risks are still there.
Kathy Bostanchik of Nationwide, thank you so much. Right now, let us turn to President Biden as he gives comments after the release of Brittany Griner.
Good morning. Moments ago, standing together with her wife Sherelle in the Oval Office, I spoke with Brittany Griner. She's safe. She's on a plane. She's on her way home after months of being unjustly detained in Russia, held under intolerable circumstances. Brittany will soon be back in the arms of her loved ones, and she should have been there all along. This is a day we've worked toward for a long time. We never stopped pushing for her release. It took painstaking and intense negotiations, and I want to thank all the hard-working public servants across my administration who worked tirelessly to secure her release. I also want to thank the UAE for helping us facilitate Brittany's return, because that's where she landed. These past few months have been hell for Brittany and for Charlie and her entire family and all her teammates back home. People all across the country have learned about Brittany's story, advocated for her release, stood with her throughout this terrible ordeal. And I know that support meant a lot to her family. I'm glad to be able to say that Brittany's in good spirits. She's relieved to finally be heading home. And the fact remains that she's lost months of her life, experienced a needless trauma, and she deserves space, privacy, and time with her loved ones to recover and heal from her time being wrongfully detained. Brittany is an incomparable athlete, a 2-time Olympic gold medalist for Team USA. She endured mistreatment and a show trial in Russia with characteristic grit and incredible dignity. She represents the best America, best about America. It is across the board, everything about her. She wrote to me back in July. She didn't ask for special treatment, even though we've been working on a release from the day one. She requested a simple quote, "Please don't forget about me and the other American detainees. Please do all you can to bring us home." We never forgot about Brittany. We've not forgotten about Paul Whelan, who's been unjustly detained in Russia for years. This was not a choice of which American to bring home. We brought home Trevor Reed when we had a chance early this year. Sadly, for totally illegitimate reasons, Russia is treating Paul's case differently than Brittany's. And while we have not yet succeeded in securing Paul's release, we are not giving up. We will never give up. We remain in close touch with Paul's family, the Whelan family, and my thoughts and prayers are with them today. They have to have such mixed emotions today. And we'll keep negotiating in good faith for Paul's release. I guarantee that. I say that to the family. I guarantee you. And I urge Russia to do the same to ensure that Paul's health and humane treatment maintained until we are able to bring him home. I don't want any American to sit wrongfully detained and one extra day if we can bring that person home. My administration has now brought home dozens of Americans who were wrongfully detained or held hostage abroad, many of whom had been held since before I took office. And today, we also remember the other Americans that are being held hostage and wrongfully detained in Russia or anywhere else in the world. Reuniting these Americans with their loved ones remains a priority for my administration, every person in my administration involved in this. We're going to continue to work to bring home every American who continues to endure such an injustice. We also want to prevent any more American families from suffering this pain and separation. And I strongly urge all Americans to take precautions, including reviewing the State Department's travel advisories before they travel overseas, which now includes warnings about the risk of being wrongfully detained by a foreign government. Make no mistake about it. This work is not easy. Negotiations are always difficult. There are never any guarantees. But it's my job as President of the United States to make the hard calls and protect American citizens everywhere in the world, anywhere in the world. And I'm proud that today we had made one more family whole again. So welcome home, Brittany. And now I'd like to invite Sherelle to say a few words, Joe. Of course, she's not excited at all about this. Sherelle, it's all yours, kiddo. Congratulations again.
Thank you. So over the last 9 months, you all have been so privy to one of the darkest moments of my life. And so today I'm just standing here overwhelmed with emotions, but the most important emotion that I have right now is just sincere gratitude for President Biden and his entire administration. He just mentioned this work is not easy, and it has not been. There's been so many hands involved, and so I'd like to take a moment to just specifically mention a few. Vice President Harris, Secretary Blinken, Jake Sullivan, Josh Geltzer from the National Security Council, Roger Cartson and Fletcher Schoen from the Hostage Envoy's Office. A special thank you to Governor Richardson and Vicky, the Mercury Players, the WNB PA for your advocacy. And also, you guys may not know this, but my family has been tremendously supported by the Wasserman Agency, BG's agent, Lindsay Colas. It's just been amazing for me and my family throughout this process. So today my family is whole, but as you all are aware, there's so many other families who are not whole. And so BG's not here to say this, but I will gladly speak on her behalf and say that BG and I will remain committed to the work of getting every American home, including Paul, whose family is in our hearts today. As we celebrate BG being home, we do understand that there are still people out here who are enduring what I endured the last 9 months of missing tremendously their loved ones. So thank you everybody for your support. And today it's just a happy day for me and my family. So I'm gonna smile right now. Thank you.
We've been listening to a press conference with President Biden and the wife of Brittany Griner, the prisoner in Russia who was the two-time gold medalist, U.S. Women's American basketball player who has been highly celebrated as an athlete, has been detained, has been released in a prisoner swap, and the emotional aspect of the prisoners who have been left behind. Let's break it down. Anne-Marie Hordern, Bloomberg Washington correspondent, joining us right now. Anne-Marie, tell us about the context of this and what's happening with the ongoing prisoners, in particular with Paul Whelan.
Well, the president is striking a joyous tone in the beginning there. He's very excited, and it's a success for them to be able to bring Brittany Griner home. There's been a lot of pressure on the administration. We know they've been talking to the Russians, and they gave them a plan, a trade swap idea in the summer. But obviously the president then trying to make sure he hammers home that he has not forgotten about Paul Whelan. Paul Whelan is sentenced to 16 years. He's been in jail for about 4 years. He's a former U.S. Marine. But the president said there, and let me just read this to you, we've not forgotten about him, sadly for totally illegitimate reasons. Russia is treating Paul's case differently than Brittany's. And while we have not yet succeeded in securing Paul's release, we are not giving up. We will never give up. And what U.S. officials are telling us is that with the Russians, it was either Griner or no one. And that's when the president made that decision to bring Brittany Griner home.
Anne-Marie Hordern, thank you so much. In Washington, D.C., you'll be covering this story, I'm sure, going forward, as you always do so well. We're going to turn to the international stage, not just with Russia, but generally with Europe, and a different picture for certain nations that have struggled in the past with rates that haven't risen as much as they have in the past. I'm thinking of Greece in particular, which is still enjoying rates that are substantially lower than they have been over the European credit crisis and beyond. Joining us now, I'm so pleased to say, is Christos Saikouras, Greece finance minister, who is in New York City to find some investors in Greece. And I'm wondering, just to start there, what's the interest like in investing in Europe at a time when a lot of people have been really questioning the recovery?
In Greece, we have proved that we have tried and we have selected important international investors, and they have invested in Greece. Just to give you an intuition, in the last 2 years, we have a historical record on investments And according to the European Commission, in the following 2 years, we will have the highest investment growth among all EU member states. So we create the preconditions through high growth, sustainable growth, reduction of NPLs on bank balance sheets, and at the same time a credible fiscal path by at the same time implementing structural reforms in order to attract investors, significant investors, especially from the US.
Structural reforms at a time when Greece is spending more to support households than a lot of other European nations through a period of elevated energy costs and just general inflation. How much pushback do you get from investors in terms of fiscal spending when they are concerned about inflation, they are concerned about debt in a higher rate environment?
Simple answers. First of all, in 2022, despite the fact that we spent a lot of money in order to support the most vulnerable part of the society through targeted, temporary, and tailored fiscal measures, we have the largest fiscal consolidation process among all EU member states in 2022. And we will reverse the situation to primary surpluses from 2023 onwards. The second comment, debt to GDP. Debt to GDP is going to decrease by 50 percentage points over the period 2021-2023. The largest decrease of debt to GDP among all EU member states since 2019. So both of these figures confirm how stable our public finances are.
How vulnerable are you to the ECB raising rates more than currently projected? This idea that there is a hawkish central bank, especially as we know that Greece's member of the European Central Bank has pushed back and said, no, come on, guys, go a little bit slower.
This is an issue that you have to raise to ECB. However, what I can tell you as a Minister of Finance of a European country is that the fiscal policy with the monetary policy should be synchronized once again, take into account the experience we had during the health crisis. And we succeeded. Once again, we have to succeed. The fact that interest rates go up is an issue regarding also public and private debt, but we have to try, as Minister of Finance, to adapt the normal policies, the suitable policies, in order to minimize the risks.
So we've talked a lot about the euro and the weakness that we've seen this year and whether that's a good thing or a bad thing. It's a bad thing because it imports inflation. It's a good thing because everybody in the U.S. wants to go to Europe, in particular Greece, and go enjoy the beautiful weather and the beaches. And we have seen incredible tourism. I have seen the pictures of it just packed Santorini or Athens, people coming to enjoy. How much do you want the weakness in the euro to continue just for that purpose?
Of course, we don't want to have this weakness. However, we have to take our advantages and create the preconditions in order to increase much more, not only the high growth, but also sustainable growth. Just to give you some figures, in 2022, it is expected, according to the European Commission, that we will have twice growth compared with the European average. And in 2023, when we'll have significant problems at the European level, as you mentioned before, we will have twice the European average growth rate. At the same time, in 2022, we will have historical records in Greece regarding exports and investments. So all of them are extremely important issues, confirming the progress, the resilience, but also the positive progress of the Greek economy.
So what's the biggest pushback that you get from investors?
The fact that the external environment is not in favor in order to invest in Greece. The external environment. And this is an issue also for rating agencies in order to upgrade us and achieve the investment grade. We're very close to the target. We have been upgraded 11 times over the last 3 years, 4 times during the energy crisis, but we are not yet there. We expect that in 2023, we will achieve the investment grade.
I have to be honest, I was recently in Greece on vacation. It was beautiful. We had an amazing time. It's lovely. Food's great. I talked to a lot of people there, and almost every single one of them had a family member who moved out of the country, to the U.S., to other places in Europe. And they talked about a brain drain. They talked about a lack of opportunity in Greece, and they had to go elsewhere, whether it was for schooling or for jobs. How are you going to bring those people back?
We did it. Over the last 3 years, we decreased unemployment by 5 percentage points. At the same time, we created some tax incentives in order to motivate all these young people but also investors, investments, and pensioners to come in Greece. And we succeeded.
Christos Staikouros, thank you so much for being with us.
Thank you. Thank you for the invitation.
The Minister of Finance over in Greece. Right now, we do want to give you a little bit of a sense of what's been happening. President Biden speaking after the release of Brittany Griner from Russia after being detained for drug possession. She has been released to the U.S. in a prisoner swap, an international arms dealer released. Just to give you a sense of what President Biden had to say, take a listen.
This is a day we've worked toward for a long time. We never stopped pushing for her release. Administration, who worked tirelessly to secure her release.
President Biden definitely indicating that they are continuing to discuss the details around releasing potentially Paul Whelan, who has been detained for quite some time and was sentenced to charges of espionage, which he says were faulty. This is something that's been ongoing and comes at a time of increasingly tenuous discussions, tenuous relationship between Russia and Western nations. They have been bombing Ukraine, taking out some of the infrastructure. It really raises a question of how much they can continue to negotiate, which has been one of the biggest question marks behind Brittany Griner's release. Today, people are celebrating her release as a sign that people can come home, and certainly her family is incredibly joyful to hear that. Right now, we're seeing in markets, it's pretty much quiet. It's been a quiet week setting up for fireworks next week, given the fact that a lot of people expect the year to basically end as you get both the CPI report on Tuesday and you get the Fed decision on Wednesday. Just real quick here, Anne-Marie Hordern joining us from Washington, D.C. Anne-Marie, how much is this a victory lap at the end of a year that has been surprisingly positive for President Biden after some incredibly low popularity ratings?
Yeah, low popularity ratings, and then of course you had the midterm elections, which really just gives the wind in his back, and especially the fact that the Senate, after Georgia, now they have 51 seats, so they not only kept control, but they gained a seat. In April, there was a success with Trevor Reed. Remember, he was also in a prisoner exchange swap, and then of course when Brittany Griner was arrested back in February for having these cartridges, vape cartridges with cannabis oil, she was sentenced to 9 years of prison. In the United States, that says that is just absolutely absurd, and there's a lot of pressure to get her back, especially in November when she moved to a penal colony. So in that sense, it is a success. And the president said this morning, it is a good morning. When he was walking out, the press was asking a question, when will she land? And we should note she will land in the next 24 hours. Lisa, the next question, of course, though, is Paul Whelan. 16 years charges, 4 years behind bars. He wants to come home as well, and this obviously is going to be very difficult for his family.
Anne-Marie Hordern, thank you so much. Coming up on Balance of Power on Bloomberg TV and radio, I'm sure they'll be talking much more about this. They also will be speaking with Greg Hands, UK Minister of State for Trade Policy. In the background, a question around U.S. stimulus and what that means in terms of drawing dollars to the U.S. and potentially away from the European Union. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Mitch and Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences, and so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City this morning. Good morning, good morning. Can we bounce back? The longest losing streak since early October. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with a big issue. How many times have you heard this?
Bonds are back.
BARB, which is bonds are back.
You buy bonds because you think recession. It's a good idea to own bonds right now. You buy bonds because you want to be hedged.
It's definitely the year of the bond.
Steve Major of HSBC agrees. High yields mean that fixed income investors can reasonably expect to recover more of their 2022 losses. Their 10-year forecast on a 10-year Treasury for next year, 250 for the end of the year. Eric Nelson of Wells Fargo taking the other side of that. One of our highest conviction views heading into 23 is that a 10-year US Treasury yield of 350 is simply too low. The 10-year nominal yield should trade up to 425 to 475 through early 2023. So which one is it? Here's PGIM's Robert Tipp.
Big picture strategically, I think we're in a buy zone. But tactically, are we a bit overbought here? I'd say yes. At the back end, these long forward rates are assuming that, 2+ years from now, a 2.5% Fed funds rate is in the bag. It is going back down for sure. Hey, that's a possibility, but I think that's highly overrated.
Joining us now to discuss is JP Morgan's Kelsey Barrow, Colin Martin at Charles Schwab. Kelsey, first to you, a 10-year Treasury yield's too low.
I would agree with the sentiment that I heard in the intro, which is that tactically, we may have run a little bit too far as it relates to this rally in yields. But I don't want to lose sight of the big picture. We do believe that bonds are back, and for the first time in a decade, you're getting income and diversification from your fixed income portfolio. If you remember back, not that long ago, 30% of the global ag had negative yields. Now only less than 3% has. And yields on the benchmarks are 2 to 3 times higher. And on the diversification side, that's been the challenge for all of 2022. You've had risk assets decline, and you've had bonds decline with them. We think now that the Fed is closer to pausing, inflation is starting to roll over, you're going to get those diversification properties from fixed income as well.
Colin, you heard it from Kelsey. You heard it from multiple others. Bonds are back, bonds are back, bonds are back. Are bonds back, Colin?
Bonds are back. We just published our 2023 outlook, and that's our main theme. So it seems like we're basically in line with most of the street. When we hear about all those views, we're generally in the camp that we do think yields should fall in 2023, but not without some volatility. when we came out with what our trading range should be, or what our sort of target is for the end of next year, we put it in the 3% to 3.25% range for the 10-year Treasury yield. That seemed like a much more bold call just a few weeks ago, and now at below 3.5%, we're not that far off. So our bonds, too low, or bond yield's too low right now. Maybe, we might see them rise a little bit in the near term, depending on what the economic outlook looks like and the incoming data. But the way we're positioning it and what we're telling our clients is that bonds are back. We do expect yields to decline, albeit with some volatility, over the next 12 months. And we continue to suggest investors lock in some of those higher yields with certainty now.
Colin, here's the pushback, and it comes from Citi. And Andrew Hollenhorst, a little bit earlier this morning when he published, he said the following: "We've been perplexed by the fall in Treasury yields, which continued yesterday. Markets are pricing a terminal Fed funds policy rate about 100 basis points above current levels, but then a rising probability of cuts in 23. That's possible. It's a possible hopeful scenario, but not a likely one in our view." What would you say back to that, Colin?
Well, I think the big question is about that potential cut. Markets are pricing in the rate cut by the end of next year, but a lot of Fed officials, including Jay Powell, have strongly pushed against that. They want to hike up to 5% or so and hold to really see how it plays out. When we look at how low yields are today, given expectations for another 100 basis points of tightening, we continue to see a deeper and more inverted yield curve. What that's telling us, though, is that the markets are expecting a negative scenario, negative results as a result of all this tightening. They expect growth to slow. They expect inflation to come down. We're starting to see it in the housing market, of course. A lot of, or certain parts of the market are showing more resilience, like the consumer. But we're in the camp that we do expect growth to slow. We do expect inflation to continue to come down as it has. And when all's said and done, over the next 12 to 18 months, we are beginning to price in those rate cuts.
Kelsey, I know you're focused on this. Which one should I be focused on? The next 100 basis points of hikes, or the cuts on the horizon being priced?
So it's been very interesting to look at the price action, because the terminal rate pricing has been very sticky. Everybody is in the same camp. They think that the Fed is going to 5. They're going to get there in the first half of the year. And then what the market has been doing recently, all the volatility in yields has been driven by the market pricing of rate cuts. So through June of 2023 to June of 2024, the market is pricing in about 140 basis points of rate cuts. And I do think there is room for the Fed in the near term to push back on this narrative just a little bit, because we're really not out of the woods yet as it relates to inflation. Now, we do think inflation is coming down, but we do have to remember that we've only gotten one CPI report and one PCE report that were encouraging. And there have been false starts before. There have been false dawns before. And so that's why I think in the very near term, we've seen a strong rally in bonds. The 10-year yield is highly inverted to the cash rate now. And we may see the Fed try to push back on that a little bit when it comes to the dot plot next week.
Kelsey, they are pushing back. We've heard it a million times, haven't we, over the last month? What do you make of the fact that this market isn't really responding to it?
Well, I think that the market is very focused on the fact that they believe that inflation is going to continue to come down. And the leading indicators are there. They are there more than they were the last time that we got a weak CPI report, and it ended up being a false down over the summer. If you look at, for instance, supply chains, if you look at, for instance, import prices, and you look at rental prices, I mean, these things are coming down. And so I think the market right now is really hopeful for a soft landing. And this is where we'd say maybe a little bit too much optimism. The rates market is pricing a very high level of concern about the forward trajectory for growth in the second half of 2023. Where we're seeing a lot of complacency is on the credit side. Spreads in high yield and investment grades still look very much like they're pricing in a soft landing, like they're pricing in a scenario where everything just turns out fine, despite the fact that we have seen the most aggressive rate tightening cycle since the 1980s.
So, Kelsey, the pushback, and you know it well, you've probably heard it on this program a few times as well. The pushback is the quality of the high yield index has improved markedly over the last 5 years. And the pushback is that even if we go into a downturn, you can't expect high yield spreads to gap wider in the way they have done in previous downturns. Kelsey, what are you saying back to the people that present that argument to you?
The quality is better. There is no doubting that. That's in the numbers. When you look at the ratings mix, it's improved over time. Some of that weaker quality has gone into the loan market, but ultimately we look back at every recession and spreads do widen into the recession. So maybe you don't get the blowout to 1,000 basis points, it's only 600 or 800 basis points. But for us, you know, we want to be invested in fixed income. This is a time to take advantage of income and diversification. We're having those conversations with our clients, but we're also saying stay high quality. We've seen an enormous amount of tightening, and spreads are still very complacent here.
So, Kelsey, right now they're about 450. What would you say is the appropriate level for credit spreads? I'm trying to work out what you and the team are waiting for. How much wider they need to be for you to say it's time to step in?
So it is extremely difficult to time exactly the peak in spreads. They're at the peak in spreads for only a moment in time, and then you start to see the policy reaction and they come back in. So we would try to be scaling into high yield as spreads widen and become more consistent with a recession probability. So in my mind, that's 600, 650, 700. You're stepping into those markets as they are widening, knowing that the all-in yield and the break-even, the fundamentals, are going to support you as you enter that market.
Colin, do you agree? And I guess when you say bonds are back, you don't exactly mean high-yield credit yet.
That's right, not yet, John. And I agree with almost all of Kelsey's points. If we look at what the upside for yields is, if you look historically, I think it's easy to point to that 800 basis point level as I don't want to say a goal because that implies a good thing, but somewhere where high yield spreads could rise as we enter a recession. But maybe because of that higher quality mix, maybe we don't get to that level. So we're looking more in that 6.5%, 7% or above. But as Kelsey said, you'll gradually move in to take advantage of higher spreads. I think an interesting point about that pushback that you highlighted about that higher rated quality mix. Again, Kelsey made a really good point about the loan market. If you look at high yield and loans, you have to look at it in aggregate, and loans tend to be more in that single B range. But also, if we look at number of issuers, this is something we've been looking at. The number of issuers that have low B or below ratings has really risen over the past decade. And our take on that is that's been a result of the low interest rate environment, people looking for yields, and there's been these corporations that might not have a lot of debt outstanding, but were able to tap the markets, were able to issue debt with those low ratings because there was demand for them. So even though these are small companies with maybe not a lot of debt outstanding by themselves, if you add them together, we think that poses a risk as we enter a slowdown.
Kelsey, just one final question on the Fed looking ahead to next week. I'd love your view on this. There are three tools for the Fed next week, for the chairman at least. He can communicate through the statement, through the projections, through the news conference. What do you think he's going to lean on to push back against financial conditions? One of those three? All of those three? What are you more focused on?
The dot plot is going to be very interesting. I think you are going to see more participants pencil in a policy rate above 5 for 2023. So the distribution of the dot plot in September was really interesting because 5 appeared to be a ceiling. Nobody projected, not even the most hawkish member of the Fed, projected that the policy rate could go above 5. I think you are going to see a few policy members suggest that getting a bit above 5 is going to be appropriate. But I think also he is going to need to communicate a few more things in the press conference, particularly around wages. He's talked about the fact that the rental or service inflation ex rental prices is really going to be the most challenging part of inflation for the Fed to tackle. And the risk is that they claim victory too early, wages end up staying sticky, they pause at 5%, and then they have to go even higher when they realize that the labor market hasn't weakened enough to get the outcome that they're looking for.
We'll talk about that next. Kelsey Barrow, Colin Martin, sticking with us. Right now, equity futures recovering somewhat, up 0.5% on the S&P. Coming up, is the consumer tapping out?
What you see in our deposit balances is year over year, they're up about 10% for, say, median income households, but they're starting to deplete.
That conversation, up next.
genomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Slowing down, there's no question about it, but we're not in a recession yet. Consumers and businesses are still spending, and why wouldn't they be? Excess savings, is around 1.5 trillion among consumers. That's down pretty significantly from the pandemic high of 2.3 trillion, but it's still pretty high. And moreover, the labor market's really strong. This cash cushion means we can ride out the first half of next year without a recession, but then I think we're going to see the economy dip.
Mounting concerns over the fate of the U.S. consumer. U.S. Bancorp's chief seeing an inflection point in consumer spending, saying the following: things are good today, but that cash cushion is going to start to dissipate, and that will create a change in behavior. Synchrony's CFO highlighting the difficult spending decisions facing Americans already, saying the following: what we hear today is, I can't make my rent. It's up. Inflation is killing me on gas, on groceries. You see that. Team coverage starts right now with Shanali Basak and Mike McKee. Hey, Shanali.
John, that's a really realistic view here, because you hear a lot of the bank CEOs still saying the consumer is healthy, the consumer is healthy. And while that might be true, you have to take a note here from a person like Richard Fairbank, who has run Capital One for decades here. His stock this year is down about 35%. And he's saying while credit metrics are still holding up all right, better than they were in the past, the trajectory is what is the bad news. Now, you take Jane Fraser, for example, over at Citigroup, and what she is thinking of here is a rolling recession around the world, in which case the American consumer is still in much better shape than what you're seeing around the rest of the world. And there's some benefit here, she says, to that rolling recession, because the whole world doesn't go into trouble at the same time, in a better case scenario here. But there still is, in her view here, a likely recession next year. You've heard Brian Moynihan say that could be mild, but you hear a lot more skepticism from a lot of others like David Solomon over there at Goldman Sachs and some of his biggest hedge fund clients as well that have still taking a bearish view. Just a couple months ago, John, we were talking about how the consumer would hold up these banks, and now you see it in the stocks that they're performing much more poorly when they're exposed to consumers.
What a turn. Mike McKee, we've been talking about this for a while. You heard it in Shanali's conversations throughout this week. Just how big is that cushion, and what's left of it, Mike?
Well, there are varying kinds of estimates, John, about how much is left of the cushion. You can see that we put an enormous amount of money, $4.5 trillion or so into the economy, the federal government did, when the pandemic began. Now it's been spent down to maybe $1.7 trillion, which is still a lot of money. But the big thing here is this is what Shanali was talking about, the idea of momentum starting to shift. You can see the yellow line there, consumer spending, that is bank deposits rather, starting to roll over as people start to spend down what they had in the bank. However, credit card use picking up, and you can see there that we are still at debt-to-income ratios below where we were pre-pandemic and below where we were quite some time ago in the early parts of this century. So we can still afford to take out more credit card debt, and that's kind of the debate here is, do we see people stop spending because the cash cushion goes down, or do they just change the way they finance it? Now, what we are seeing is a decline in retail sales, since the Fed started raising interest rates. That's the Red Book year-over-year weekly spending patterns. And so the question is it that that's going down, or that it is still higher than it was pre-pandemic? And that's going to be the question when we come down on a percentage basis in terms of spending. Does it drop below where we were and then suggest we're going to have a contraction, or does it just mean that we get some negative numbers in spending, but we don't see people stop spending?
So, Mike, this raises a question I asked a little bit earlier this morning. The base case is we get a recession next year. I'm trying to work out if the bigger risk is that gets brought forward or pushed out. Mike, as you read things right now, the balance of risks around that story, what is it?
Well, the balance of risk would probably tell you that it gets pushed out a little bit, maybe, because Americans are still spending and we're still seeing people get raises. So if inflation's coming down and Americans are making more, relatively able to keep more of their paychecks, then that means they can keep spending for longer. And we know from historical studies that Americans' spending is primarily based on what they earn rather than what they have in the bank or any kind of additional bonus.
Mike McKee, great as always. Schnally, thank you to you. We're going to catch up with you again in about 20 minutes' time. Looking forward to that conversation on Blackstone and real estate. You don't want to miss that. Back with us, Kelsey Barrow, Colin Martin. Kelsey, to you, how do you think about this issue right now? Just how big that cushion is for consumers, if there's a cliff edge at some point on the horizon?
Well, it's not a cliff edge. We have been seeing consumers draw down on their savings. So the way I would think about the health of the consumer is ability and willingness. So right now, I would say on the willingness side, there's still a lot of willingness to spend. People want to go out, they want to have experiences, and they still have a job with an income to support that. On the other side, you have ability. We know that the cushion of savings is coming down, but at the same time, they can lever up. They can take on more credit card debt. We're seeing that. We're seeing people start to use their credit cards more instead of drawing down on those savings. And so there is both ability and willingness right now for the consumer to continue to spend. And I think that has really been the bright spot and the engine in this economy, despite the fact that we are clearly in a recession when it comes to the housing and manufacturing parts of the economy.
So, Colin, this raises a few questions for me. I'm told repeatedly about how strong consumer balance sheets are, and to Kelsey's point, there is space there to continue levering up. With that in mind, Colin, does that tell you more about how deep a potential recession could be, or does it tell you that actually we should be thinking this recession might be pushed further out?
Well, I think there is a chance that it gets pushed further out because as we stand now, we're already at the end of 2022 right now. The labor market remains strong. Non-farm payroll gains remain strong. We're still seeing wage growth and we're still seeing strong spending numbers. So it does look like there's a chance that it gets pushed back. I think a risk that when we talk about consumer credit and borrowing going up, that doesn't sound like a good thing to me, especially in a rising rate environment. I think it makes it way more difficult for consumers if they've depleted their savings and then they start borrowing at higher rates, whether it's credit card rates, higher auto loan rates, or home equity loans. I think that's a problem down the road. Now, I think when you look at the big picture, we're seeing all the signs of concern out there, especially with bank CEOs, various survey measures, but we're just not seeing it in the spending data just yet. We do expect that to happen probably in 2023. I think when you look over the last 6 to 12 months, we saw, really the first summer vacation season where people were spending, then that goes into the holiday spending season. As the calendar turns, we go into 2023, we do expect some of that spending growth to slow.
Hey, Colin, if you were looking for World Cup football today and you accidentally stumbled into a business channel and heard this conversation, there's no World Cup today for what it's worth, and you heard in the space of 10 minutes concerns about wage pressure and then at the same time talk of recession, Colin, how would you explain that to people?
Yeah, I think it is a challenge. I mean, we hear about recession a lot, but you don't really see it in the numbers just yet. You see it in some surveys, but not the actual hard data. Our concern, and it's all related with wage growth and then the Fed reaction function. When we see wage growth lead to inflation and then tighter Fed policy and tighter financial conditions, that should slow growth. I mean, it's making the cost of money more expensive. It's going to make it more prohibitive for me, for you, for any consumer to continue spending at the rate that we're spending at. So while things might look pretty good right now at the actual data, when we look at the outlook for tighter financial conditions banks tightening lending standards, and just making the cost of spending go up, that's a risk to us.
Hey, Colin, great as always with a brilliant Kelsey Barrow. To the two of you, thank you. Coming up, why Bank of America thinks not owning equities into the new year is a big risk. That conversation's still ahead with Morgan Stanley's Dan Skelly.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell, let's get you some morning calls. First up, Argus upgrading AT&T to buy, saying telecoms historically perform well during slowdowns. Piper Sandler initiating coverage on JP Morgan. Overweight, calling it their favorite quality name. And finally, UBS upgrading Hersey to buy, seeing a promising setup for growth next year. That stock is up by 1.6%. Coming up, why Bank of America believes not owning equities is a big risk, and why Morgan Stanley's Dan Skelly is taking the other side of that bet. That conversation up next. Equity futures positive. The opening bell just around the corner.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Five-day losing streak on the S&P 500, longest losing streak going all the way back to early October. Right now, trying to make sure it doesn't become 6. Equities up by 0.5% on the S&P. On the Nasdaq, we're firmer by 0.5%. Also on the Russell, the small caps up by close to 0.6%. Let's see if this sticks. There's your opening bow. Switch at the board and get to the bond market. Going into next week, when we get CPI and a Federal Reserve decision, yields are higher by 6 or 7 basis points to 348.19 on a 10-year. Interested in the front end of the curve in the Treasury market, a 2-year at about 430. BMO think there's some real upside risk here. A 2-year that's facing 450 on Fed funds next week and a higher dot plot as well. Going into it, they think that yield needs to be higher. In the FX market, euro dollar 105.30, positive 0.2%, some dollar weakness again, bit of euro strength. And crude, what a year it's been for this market. $74 a barrel on WTI, up by 2.8%, and still risking finishing the year in negative territory. Hardly anyone would have seen that coming about 6 months ago. Equities right now up 0.5% on the S&P 500. On the Nasdaq, up 0.5% also. About 40 seconds into the session, one stock to watch, Carvana. The company's creditors preparing for negotiations to rework the debt load. Wedbush slashing their price target on the stock to $1. Writing the following: these developments could leave the equity worthless in a bankruptcy scenario or highly diluted in a best case. Here's Abby for more. Hey, Abby.
Hey, John. Well, yeah, it's really pretty incredible here. And that, of course, is because equity stock is the lowest in the capital structure, so last to get paid. But, you know, one question we often ask about securities, how low can it go? Well, in the case of Carvana, not much lower. It is down 99% literally from its August 2021 peak. And a lot of this has to do with profitability. Now, this once darling online used car company, in 2021, they put up a loss of $1.62. This year, John, that estimated loss is of $8.91. Next year, it's expected to be a loss of greater than $9. But this really isn't a stock story. To your point, it is a credit story. One bond is now trading at 41 cents on the dollar. Once you have bonds go below 50 cents on the dollar, it's often wondered whether or not there's a going concern risk. And of course, that's what's happening here. There is the possibility of restructuring the obligations. And one thing Carvana could have done, they could have tried to pit one creditor against the other, but the creditors, including Apollo and PIMCO, they're coming together to try to restructure them down, to restructure the bonds together, probably so that they get paid the most that they possibly can. I was talking about profits. There it is. It's really an issue, not just from the standpoint of profitability on the balance sheet, but also for the cars, the profitability per car. So it's interesting, John, because at the peak, this had been a $376 stock. Revenue is actually for this year up 33%, but that profit picture of profits just going absolutely in the wrong direction tells you that there's either a problem with the business model or maybe it's coming out of the pandemic. It's an interesting thing to ponder, and playing it forward, what other companies? We had headlines not so long ago about Blue Apron, some of them talking about that they believe that they have sufficient cash flow. The stock had been held pending. They're going to be working things out with their creditors. Sure, they're talking about it. How many more companies will we be seeing this through this more difficult environment?
What a brutal turnaround. What a brutal sell-off. Abby, thank you. One further stock to look at, one more name, Tesla, down every single day this week. This morning, down by about 6 or 0.7%. China's reopening prospects giving no reprieve to the name. The car maker said to be shortening production shifts at its Shanghai factory and and delaying the onboarding of new hires. Dan Ives of Wedbush seeing it as nothing more than a near-term setback.
I think you're starting to see a bit of a demand issue in China. And that's something that I think Tesla's adjusting to. I still view it more near-term, not a long-term systemic issue. But look, after a Cinderella story, that they're starting to clearly hit some hurdles in China. But our thesis for 23 in terms of 2 million units globally continues to stand.
Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. We're down about 1.2% on Tesla, as you said, down for a fourth straight day. Its worst run of declines in almost 3 weeks. What Tesla is doing, according to sources, is cutting the number of hours across 2 shifts at the Shanghai plant, and they will stop onboarding new hires, which gives us a sense of the direction of travel for the ramp in production there. It's worth noting 2 things, Jonathan. They are coming off a record month in November in terms of vehicles produced and delivered out of that Shanghai plant domestically and internationally. As always, we went to representatives of Tesla in China and requested comment. A representative for Tesla in China declined to comment in the story. That's just one of 3. There's a lot in the news cycle around Tesla that investors are passing this morning. The second being that, according to sources, Musk's bankers are considering swapping out about $3 billion of the unsecured debt at 11.75% for margin loans, secured or backed against Tesla stock. This has been an ongoing story, as you know, John. As always, according to sources, this is not a final decision and the situation could change. But as we know, the debt which was taken out by Musk and put on Twitter could have annual payments of $1.2 billion. So this would somewhat lighten the load for the company itself, but put more risk onto Musk. The third story, Jonathan, if I may, we reported overnight, my colleagues and I, that Tesla has moved its head of China, Tom Zhou, from Shanghai to Austin. And he has come with a team of engineers, according to sources, to help with the ramp there and get things sorted in what is a really critical US operation for this company.
Nice reporting, Ed. As always, buddy. Thank you, mate. Stock's down about 1.5% on Tesla. For the broader market, about 5 minutes into this session, we're positive 0.2% on the S&P. On the NASDAQ, we're up about 0.1% or so. We caught up with Bank of America's Savita Subramanian recently, saying the biggest risk for investors heading into 2023 is not owning equities.
I do think that we are going to go down and then up. The problem is that is an increasingly consensus view. So I think the bigger risk heading into the first half is actually not being invested in equities. Not having exposure to stocks and sticking all your money in bonds and cash is a mistake at this point.
Invesco's Alessio De Longis agrees. He wrote the following: our macro framework moves to a recovery regime. As improving risk appetite signals improving growth expectations in the near term, this presents an opportunity to tactically increase portfolio risk. Dan Skelly of Morgan Stanley joins us right now. And Dan, I guess your first job is to tell me why they're wrong.
Sure. Good morning, Jonathan. And look, we've heard a lot of sell-side updates in the last couple of weeks, but let's face it, the markets continue to dance to the tactical drumbeat of Mike Wilson. And, you know, he was calling for a tactical rally in October. And just over the last week or so, you know, as a firm, we've become a little bit more cautious, just given we've rallied so hard off of those October lows. So, Jonathan, look, I would say the following. It has been a grueling bear cycle the last 10 months for almost everything, stocks, bonds, et cetera. I think, as you well know, and we've talked about for a long time, the original thesis was about fire and ice, Fed pivot, tightening, and then a growth slowdown. Obviously, phase 1 has played out. I think phase 2, you could argue, is also seeing signals that it's being reflected. Just look at, frankly, the move in the long bond over the last, call it 30 or 40 days or so. We've had like a 15% move long in terms of duration. Look at the slowdown in WTI and oil prices. So you can't deny that a growth slowdown is starting to be reflected in certain asset classes. Just lastly, why are we not going all in aggressive at the moment and becoming incrementally cautious? It's all about earnings. As Lisa Shallett has said, as Mike Wilson has said, we still expect some earnings disappointments come January, February.
Dan, much of this year, though, at times, when you were making these big calls, you were flying solo. Now you've got a lot of company. When I played that sound there from Savita, it's the first time I'd heard that kind of thing. Likewise with Alessio De Longis, the overwhelming consensus is that we get a retest of the low maybe from this year in early next year, and then the Fed has to back off and equities rip. And I'm going to go through a couple of quotes just to share with you just how much company you've got right now. This from Marko Kolanovic at JP Morgan, who said the following: we expect the lows we've seen this year in equity markets will likely be retested in the S&P 500 early next year. We see an ongoing trend of pullback in risk assets. That's Marko. Here's Chris Harvey at Wells Fargo. We believe the S&P will trade as low as 3410 in 23 as rates eventually back up and spreads widen. Ultimately, their year-end call, 4,200 on the S&P, but still a retest of the low. Does it make you nervous and more uncomfortable, Dan? And I found myself asking that question of you many times over the last few months as you get more and more company and people start to take the same view, and this becomes overwhelmingly the consensus view going into 23.
Sure, and listen, Jonathan, just because it's becoming increasingly consensus doesn't make it wrong. I think, on the flip side, when we look at downside scenarios, Mike has talked about this 3,000 low potential in January. Now, that would be a dramatic low from here, a downside scenario from here. I think a retest of the June lows or the October lows, call it 3,600, would be reflective of maybe more resilient earnings, maybe earnings disappointments, but not to the magnitude Mike's expecting. And I think the second thing, and you've been talking about it all morning with your guests, is about the economy. Obviously, the economy is slowing, but you could also make a case that there's some labor resilience, that there's some spending resilience, particularly on the high end when you look at the income spectrum. And then lastly, and we've talked about this year, when you look at the traditional blowups in credit, from an industry perspective, it's ironic in that given the mix from goods to services and given this massive move up over the last year in energy prices, the traditional weakest hands in credit, i.e. energy and consumer cyclicals, hotels, airlines, fundamentally, they're actually in some of the best positions from a cash flow perspective. So as long as credit holds up, as long as labor and spending holds up somewhat resiliently, you're just not going to get an enormous economic downside. So we're not saying to be all out either. There are opportunities. Just lastly, very briefly, we've started talking more and more about emerging markets as an idea.
I know you're thinking more and more about leadership beyond just EM. Dan, when it comes to tech, I want to understand where you are on that. And in the meantime, take a listen to what Savita of Bank of America had to say on tech just yesterday.
I think lessons from 2022 are that cycles take a lot longer to play through than everybody expects. And I was expecting to end the year with the world overweight energy and inflation plays and underweight tech because of the performance we've seen. But I think the lesson is that investors have muscle memory of making money in tech stocks for 10 plus years, and that needs to go away. We need a full washout, and we haven't seen that yet.
Dan, just a final word on tech if you can.
Sure, yeah, fair point. I think she's right in terms of investor sentiment and that Pavlovian urge to always go back to what worked previously. All I would say is, the reality is the fundamentals and the end markets that many of the tech stocks play into, connectivity, cloud, digitization, big data, these trends aren't going away. So in a world of free money a year or two ago, sure, the stocks were overpriced. But if we get to a point, as Ellen Zentner's expecting, of a definitive Fed pause in early 23, you might actually start to see some of the higher quality tech names start to work again.
Dan Skelly, awesome as always. Dan, you mentioned Lisa, Ellen, Mike, the whole team. It's been a fantastic year for you and the team over at Morgan Stanley. We appreciate your time here on Bloomberg. Equities right now up 1/4% on the S&P, about 11 minutes into the session on the NASDAQ, up by 1/10 of 1%. Coming up, Blackstone's response to mounting concerns over its real estate fund.
This is an industry trend, and there's two stories to this. There's the redemption story, why redemption's rising, and then there's the limit on redemption story.
That conversation still ahead.
700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
There's definitely going to be a reset, a further reset, and I think anybody who knows anything about private markets knows that it's going to happen with a lag, but it is going to happen. Whether you're in private credit, whether you're in private equity, whether you're in private real estate, you should expect lower marks in the coming quarters. And again, for investors who are invested in some of the funds, that's just the expectation, but you're still getting the income on something like private credit.
Blackstone's $69 billion real estate fund rattling markets after a jump in redemptions. The CEO, Steve Schwarzman, dismissing investor concerns at Goldman's Financial Services Conference. Here's what he had to say. The idea that there is something going wrong with this product because people are redeeming is conflating completely incorrect assumptions. This was not meant to be a mutual fund with daily liquidity. These are pieces of real estate. Shanali back with us for more. Hey, Shanali.
It's a real test of the market, John, here, and this has really been the talk of the town because we haven't seen a moment like this. This is a $70 billion fund here, and when you hear what Steve Schwarzman is saying here about what happened, he is saying that they had found out that a lot of investors here in Asia had really pulled a lot of money here as the Hang Seng Index was down so dramatically. So what you're seeing here is regional investors pull pretty dramatically, but also the performance here holding up of the fund itself. He said the returns are 13% on average for the last 6 years. They're earning 9% in an environment in the first 3 quarters of the year when the S&P was down 25%. So performance itself was good, but you see a mismatch here from the types of investors that they had in this particular fund. Now, how much anxiety has been caused in the market around what we've seen around BREIT. You also saw them hit the redemption limit here for BCRED, which is a credit fund as well. You saw every single one of his rivals at the Goldman conference answer to this issue in the market and whether others are facing similar issues here. And to your point, I think we were talking in the commercial break too, how much is this a worry about underlying private assets? That is some of the worry here, but there's also a real worry here about the structures themselves. All of these asset managers, huge institutional asset managers, have been courting retail money. And a rival, the CEO of Blue Owl, has a little piece of paper on his desk that talks to the $220 trillion market in the wealth market here that they have been raising from here. So all of these folks really need these structures to work because that is a huge market opportunity, and these folks are looking for new things to invest in a real estate and credit market that has dramatically changed since 2008 and is bound to change more after this market cycle that we're seeing now.
Some big money in the mix, that's for sure. Shanali, appreciate the reporting. Thank you. We caught up with Mohammed Al-Arian last week on Blackstone's redemptions. He said it's a part of a bigger phenomenon. Take a listen.
When you run a financial system at very low rates and abundant liquidity, the financial system will optimize those conditions. And one of the ways in which it has tried to optimize those conditions is by offering liquid, relatively liquid products on illiquid asset classes. And we've seen that happen in several places, including in real estate. So when you offer relatively liquid instruments on illiquid asset classes, and the asset class becomes truly illiquid because the financial conditions change, you get what you're seeing in Blackstone.
PGIM's Taimur Hayat calling the shift into private markets inevitable, but not without risk, echoing concerns over liquidity constraints and transparency. Taimur joins us right now, I'm pleased to say. Taimur, fantastic to catch up with you, sir. Thanks for your time. Can we start there? Just get your thoughts on what's been developing with Blackstone and this fund.
Absolutely. I think this was an inevitable learning moment when a whole new client segment, retail investors, high net worth investors, came into private alternatives. It is inevitable that when you have less liquid strategies with leverage in a retail vehicle, that you can't get access to it with daily liquidity or even with monthly liquidity. So I would say these products are well structured. The big players in the market have learned from the global financial crisis how to create these, but it is a learning moment for retail investors that when you have underlying illiquidity, you can't get monthly or weekly liquidity, but the returns may be worth it. And the real question, I think, is once the redemptions end, will investors come back or will they be soured by this experience? How ready are they for the returns, but also the risks of private markets, Jonathan, is the real question.
Taimur, I'm interested in the risk in private markets and how that shapes public markets and vice versa. Clearly, if you're in public markets and you're facing margin calls and redemptions, and then all of a sudden you've got to go and get this pool of cash that you can't get because you don't have liquidity in private markets, is a private market problem a public market issue ultimately, or is it the other way around? How do you think about that feedback loop?
Yeah, I think it's very interesting, Jonathan. Really, sort of three things have happened since the global financial crisis. You had the commercial banks just step away from risky credit of all kinds, and a whole set of new actors come in. You had companies who realized they could stay private for much longer, maybe forever. And you had investors who were desperate for yield back then and said, we are going to move into private markets where we can get more yield. Now, those investors, all our clients at PGIM, discovered that actually the illiquidity premium, the diversification, a range of benefits in private markets actually makes it attractive. And I'm thinking real estate debt, private equity, private debt, infrastructure. But you're absolutely right. When, you know, the cocooning of the world economy by the central banks goes away, some real vulnerabilities arise in private markets, and that's absolutely a cause of concern.
How are you expecting that to materialize? Because clearly these investments made sense at 25 basis points on Fed funds, maybe 1%, perhaps even 2%. How does it work at 5%?
It really exposes some vulnerability. Some we've already seen. We've seen the collapse of the cryptocurrency market. We've seen real estate values in the REIT market come down. So the obvious bubbles in the economy have already come. But what we are looking for next at PGIM is what are the other vulnerabilities. One is there's just less transparency and information once we move from the 5 big banks to a much broader set of private credit lenders. And I think the recession ahead, the stagflation in many countries, is really going to separate the Johnny-come-latelys who haven't really had the experience of underwriting for down markets versus those who've had that experience, who worked through multiple cycles. And I think it's also going to separate private credit, Jonathan, that relied on sponsors, where activity is really going to dry up given, you know, they're relied on leverage, versus those who had direct origination. So there's going to be a sort of a winners and losers divide in private credit. And then the other risk I think investors should look at is more transparency in the parcel game that is happening in private equity, where with continuation funds and subscription lines, you're never getting a mark to market from public markets on private equity companies, but they're passing from one fund to another or getting a subscription line. I think that's a trend to look at very carefully and another place for vulnerability.
Forgive me for only giving you 30 seconds to answer this, but that's all I've got. How are you as a firm managing this risk, Taimur, at PGIM going into next year?
I think this is a time for humility, it's a time for scenario analysis, and it's a time for not jumping in too soon. But nevertheless, Jonathan, we think next year, late next year, a little later than people think, this will be one of the best investment markets for both public and private assets. But patience is key.
I keep hearing that. I keep hearing the same thing. The PGIM COO, Taimur Hayat, thank you, sir, as always. Coming up on this program, the trading diary just around the corner. Equities In the equity market, trying to snap the losing streak on the S&P, we're positive by 0.5%. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Coming up to 26 minutes into the session. On the S&P right now, just about positive by 0.5%, snapping a 5-day losing streak. On the Nasdaq, we're positive by 0.4%. That's the price action. Here's your trading diary. Coming up, President Biden discussing the state of the economy at 2 p.m. Eastern Time. PPI data coming up on Friday. Plus, we get the UMich Consumer Sentiment Survey. Then the big week just around the corner. CPI on Tuesday. Fed rate decision on Wednesday. The Bank of England and ECB coming up on Thursday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps. And he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fiero took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fiero continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night
as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS